with monetary policy acting with the lag, we have to assume there are more shoes to drop here and more banks to fail.
What I'm more skeptical about is the decline in inflation.
Fed cuts being priced in right now far too aggressive.
The move for all the central banks getting from 5 to 2 is where the real challenge lies.
I do think that we are going to be looking at, again, slowing inflation, a slowdown in the economy, most likely a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I came back just to talk about the debt ceiling. So exciting, isn't it?
You did not come back just for that.
Just for that. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.4% on the S&P 500. TK, a meeting between the President and the House Speaker delayed. We're told that aides will carry on speaking. They were meant to be meeting today. That's going to be pushed back.
Yeah, there's some politics there. There was a meeting between Anne-Marie Horton and Secretary Yellen in Japan. Maybe there's some substance there about the debt ceiling. I think people are pretty much exhausted about it. What I'm focused on this morning, John, is a problem that won't go away. And Mr. Diamond mentioned it yesterday to Francine Lacroix. The morning bank charts are really, really not good on a Friday.
The problem that won't go away, I think a lot of people feel the same way about the debt ceiling conversation as well, TK. Yeah. But I'll go with you. PacWest yesterday crushed, hammered. Lisa, here's the quote from the company. The news headlines increased our customers' fears of the safety of their deposits. We understand that deposits fell 9.5% last week. In the subsequent days, the days after, news reports suggesting they were in talks with investors.
This is the sort of conundrum underneath the regional banking crisis or kerfuffle or whatever you want to call it, that if you looked at Western Alliance, they came out and said that they've actually increased deposits at the same time. So is this a PacWest problem or is this something broader? This just seems to feed into the narrative that these banks can't catch a break at a time when there already is this sort of existential pressure from higher rates.
BKX has the same technical patterns. It's not as ugly as PacWest, no question about it, but a blended index of bank stocks, John, really is not quite good on a Friday.
In the pre-market right now, 471. We'll return back to that name a little bit later in the programme. This is what we look like this Friday morning. Good morning to you all and welcome to the programme. Your equity market positive on the S&P 500 by 0.4%. Lisa, yields a little bit higher by 3 basis points. Your 10-year 341. Yesterday on euro dollar, very close to a break of 109. Look out for that again this morning.
She
and through
did.
The rest
when you
of the
were
session.
Gone, she spent her entire time on euro.
Ramo, 109.11 on the euro right now.
He's making that up. I did not spend the entire time. And just in case you're wondering, at 10 a.m., everyone's favorite gauge, the University of Michigan Sentiment Survey, comes out. I'm actually not that interested in how much the headline number comes down. I'm much more interested in expected inflation rates because last time we got this, we saw an unexpected pop in longer-term inflation expectations. And to me, this question of are we normalizing higher inflation is something we really have to talk about more.
100% dead on. You look at the 5 to 10-year inflation expectations, and this is this word anchored, unanchored. You're 100% correct on that.
Especially because a lot of people are not that concerned anymore about inflation. Fed speaker is still concerned about it. And today we're going to hear from San Francisco Fed President Mary Daly. She is not going to probably be trying to talk about oversight, but that is what I want to hear about. She's giving a commencement address at USC. 7:45 p.m. Eastern time, we get Fed Governor Philip Jefferson and St. Louis Fed President James Bullard. We have heard from others talking about the need to continue to combat inflation. And this weekend, those G7 finance minister meetings continue over in Japan. We're going to hear from Anne-Marie Horton. But to me, how much is the focus for these financial stability, to go back to the other question, and that chart that Tom was talking about, the KBW Regional Banking Index, the lowest right now since November 2020.
AMH coming up in about 10 minutes. Looking forward to it. Just to confirm on the euro against the dollar, a break of 109 in the last hour or so. 108.99 is the low of the session. Joining us now is Chris Morangi, the co-CIO at Gabelli Funds. Chris, wonderful to catch up with you, sir. People are so frustrated with the debt ceiling debate, and it's only just got started. Chris, can you ignore it? Can you operate without even paying attention to it?
Well, you can't ignore it, certainly for the next 2 weeks, hopefully not 3 weeks. It's going to be in the news, something we have to pay attention to. But we don't necessarily have to act on it. And one of the hardest things for an active manager to do is sit on their hands. And that may be the prescription when the bedrock principle of corporate finance is that T-bills are the riskless assets, and that is the very asset that may be at risk. What do? It's hard to manage around it. We're doing more of the same, looking for good cash-generating companies that have good balance sheets. They're going to wake up the day after we go off the cliff, if we go off the cliff in that unlikely circumstance, and be just fine.
Chris, Mario Gabelli with us the other day. I didn't have time to get to him on this. Let me go to you on it. You guys love value. You love fundamental analysis, and particularly you love a 3-year time frame. Can you buy the banks here?
We've never been big fans of the banks for a number of reasons. One, you think they're largely commoditized businesses, borrow short, lend long. They tend to be black boxes, and every so often, probably more often in the last decade or so, been subject to these panics. So I think the bigger issue with the banks is not so much getting depositors comfortable that their money is safe. It's they're going to have to raise the money that they pay to depositors to keep those deposits. That's going to squeeze net interest margins and ultimately earnings. And that's a harder problem to solve when treasuries are where they are.
An even harder problem to solve is a lack of lending from these institutions that punch above their weight in terms of how much they lend to the consumer, to corporations in the United States. It's been one reason why people have been moving away from U.S. equities and then going international. How much are you following that and looking more at international companies, in particular those exposed to China's recovery?
Yeah, that's been obviously year to date been a fertile place for ideas. Obviously, the rest of the world has lagged the U.S. for much of the last several years, and there are some relative bargains there. You know, one could argue that obviously they're less exposed to some of the dynamics that we have in the U.S., whether it's the debt ceiling crisis or an upcoming election. So yeah, we're always looking for non-U.S. ideas. We tend to look globally by industry, so we're not necessarily looking for European companies. We're looking for companies and industries that we like, whether it's distilled spirits or media or, you know, certain areas of industrial like agriculture.
I love that. Distilled spirits, that kind of is independent from the credit cycle, which is kind of nice.
It's Friday.
Right? Yeah, it's Friday. So you go to distilled spirits. I am curious, though, what your biggest change has been over the past month, especially given some of the turmoil and the increasing rhetoric around the debt ceiling. Putting aside how much you're worried about it, just what's insulated from that potential volatility?
Well, I would say we just came through earnings season, and my views, at least, have been mostly confirmed, which is that the economy is slowing, but not falling off a cliff, like the economic cliff, not the debt ceiling cliff. And we're probably going to go into a recession at some point, but it's going to be manageable. And companies are taking action. We're seeing more cost actions. That was a theme of the fourth quarter earnings calls, and trying to protect margins. So absent a significant tightening of credit, which may or may not happen depending on the debt ceiling issue, we think we'll probably be okay this year.
And distilled spirits, let's say it's a company that owns Beefeater, Chris Marangi, like Pernod Ricard. You got a 15% dividend growth. Is that why you're looking at distilled spirits? They got enough free cash flow around and they actually have dividend growth? All of it off of Beefeater and Beefeater 24?
Something like that. Yeah, listen, they're obviously very long-lasting brands. They're going to last well beyond this debt crisis and many others. And there's global growth. Some of it's from China, some of it's from other areas of the world, but they generally have pricing power, and durability, and that's what we like.
Chris, wonderful to get your view. Chris Marangi there of Gabelli Funds going into the weekend talking about, Tom, distilled spirits.
Distilled spirits, and what's great there, particularly on a Friday going into Saturday and brunch, John, and a Tang mimosa is great with Mum Champagne from Pernod Ricard. A Tang mimosa can be quite good.
Literally the worst thing I've ever heard. It's disgusting. It sounds like it would explode if you tried to combine
This is really serious stuff, and this goes to luxury, and what he talked there about is durability of brands and the fear that's out there, John. There's some of the fears that we're going to recalibrate on this weekend, including the debt ceiling, is people are looking for stability of cash flow and products of stability. And that's where you hear Gabelli talk about these brands that just seem to endure. We make jokes about it, but it's amazing how they endure.
Or they're looking to have a drink. What was the champagne you recommended
Mum's,
alongside that Tang?
Mum's, very good.
That might be an improvement. That might be an improvement.
That might be an improvement.
Just adding some
Well, the proportions are important here. I must admit, Mum's, it's a splash of Tang.
This is a breakfast show. Come on.
All right.
That's what Tang's for,
It's horrible.
Get the day started like the astronauts.
Bramo, keep up. One Federal Reserve official has this to say. Should inflation remain high and the labour market remain tight, additional monetary policy tightening will likely be appropriate to attain a sufficiently restrictive stance of monetary policy. Governor Bowman going to be talking about this, Bramo, a little bit later.
This is frankly one of the biggest issues that people have been talking about. Why is the market pricing in cuts when that seems to be completely off the table, at least later this year? Fed officials pushing back. What can they say? They have said this before. Markets don't care. In fact, they're pricing in even more rate cuts by the end of this year. So how do you sort of translate their rhetoric into market action other than they've simply lost credibility in a way that really gives people any guidance that they have insight?
The observation under fire this week was Mike McKee, 1 minute out after the earnings. He set up a vector of service sector inflation that is disinflation. John, to Bowman's comments, it's barely disinflation. It's just sort of kind of like barely rolled over.
Would we agree it's heading in the right direction?
Yes, that's the vector.
Can you fold jobless claims into this as well? The highest since late 2021.
We did yesterday when you weren't here. We saw the markets move.
Thanks for that, TK.
You didn't see the markets move.
Thank you. I think that was my first day off of the year.
It is.
Just to confirm.
I'm glad that you had a nice day off.
Thank you. Appreciate it.
It's really
I can talk about. Do you want me to talk about my time off? Do you want to save that for later in the show?
Flesh it out for
you think that we didn't talk about it while you were gone? Exactly what you were doing and exactly your trajectory?
Fantastic atmosphere. The San Siro was absolutely rocking.
That's
just
a
beautiful.
stadium.
So special. So special and great to be there. Terrible scoreline.
Is it a true derby?
First 20 minutes was brutal.
Literally the worst game ever. I watched it.
Brutal.
I felt
First
for
20
you.
minutes was
John,
tough.
seriously, is it equivalent to a derby in London? I mean, is it the same cultural thing?
So much better. A London derby is nowhere near
Okay.
how special a Milan derby is. Nowhere near.
I mean, I saw
the history, the clubs involved in the game, and just the tension, the atmosphere.
How much hate mail are you receiving
I've been
right
to a
now?
lot of these London stadiums. They are like libraries because a lot of the major fans, the real fans, are priced out of the game now. You're talking about people who pay £100 plus for a ticket. You know, the organisation of the fans at Milan,
right,
in the Curva Sud, which is where the hardcore fans, so to speak, sit, and the things that they were doing, it's amazing. You've got to be there.
Did you take your shirt off?
I didn't, but some people did. I didn't.
Where are these questions coming from, Tom? I'll ask a question that perhaps you can answer.
Actually,
okay, hold on a second. Just a question you can answer. What are the snacks like? What do people eat?
I didn't eat. They were drinking and
This
smoking.
doesn't surprise me.
I didn't watch the game. I was watching Juventus.
It was beers and cigarettes.
That's
like,
I don't know.
It was like non-stop. And let me tell you, there was a lot of cigarettes given the nature of the scoreline.
I mean,
there's a lot of
cigarettes.
I missed it. I was watching Juventus Sevilla 1-1. I thought
you enjoyed that yesterday.
Yeah, Sevilla. I think
watched that.
they're great. It's
I was half asleep through yesterday afternoon. We've got a return leg next week. Wish us the best.
You have to score 3 goals
to win. Yeah,
and they score no goal. You have to win 3-0.
Or score 2 and take it to penalties.
Oh, okay.
So we'll see. But thanks for
still
indulging
doable.
me.
That's good.
It's good to make it happen.
That's good.
Put it on the Amex. Peter Cheer of Academy Securities.
Good morning, Reto.
Is going to join us in the next hour. Mike, if you're listening, we didn't put it on the Amex.
No, but Reto, if you're listening, we did.
Equity futures on the S&P positive 0.4% from New York. This is Bloomberg.
I love Fridays on Surveillance, keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit that was set for today. The delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. And McCarthy says the president will meet with him and other congressional leaders next week. House Republicans have passed a symbolic border security package. The legislation would ensure fewer people could claim asylum in the U.S. and lock more migrants in detention facilities. It has no chance of passing in the Democratic-controlled Senate. The bill's passage came on the same day that pandemic-era border restrictions ended, ensuring an increase in migrant arrivals. Twitter appears to be getting a new chief executive. There are multiple reports that Elon Musk is in talks to hire the head of global advertising and partnerships at NBC Universal to be the social media platform's next CEO. Linda Yaccarino joined the company in 2011 after nearly 2 decades at Turner Broadcasting. Musk has said he'll become Twitter's chief technologist. The founder of SoftBank Group, Masayoshi Son, is now personally on the hook for about $5.2 billion on side deals he set up at the company. Now, that's after SoftBank's Vision Fund venture, Capital Arm, ended the fiscal year with a record $32 billion loss. The world's largest technology investor was battered by losses on unlisted startups in its portfolio. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
only good outcome is one in which Congress acts. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills. If Congress fails to do that, it really impairs our credit rating. We have to default on some obligation. That's something America hasn't done since 1789, and we shouldn't start now.
A fantastic conversation between Janet Yellen and the US Treasury Secretary speaking to Anne-Marie Jourdain in Japan at the G7 meetings, going into what we thought was a meeting, Tom Keene, later on today between Speaker McCarthy and the President of the United States. And Lisa, we find out that that meeting has been delayed.
But the way it's being spun is that the delay is actually positive for talks. That basically the theory is that staff-level negotiators are making some progress. So they don't want to torpedo it with a lot of political rhetoric at the higher end, which is the reason why perhaps some people say this is a good thing and other people are coming out.
And to be fair, I believe someone involved in the meetings has a funeral to attend. I mean, these people are human. They got things to do on a Friday afternoon.
Wasn't aware of that, Tom. Who's that?
I don't know who it was, but I believe in the reporting somebody has a funeral to attend, which they didn't go into details on. But the answer is, okay, so they wait over the weekend. What's going to change by Tuesday? Nothing. I mean, yes, it gets you closer to Yellen's X date and all that, but I just don't see it.
There is a conclusion, I think, out there that this gets worse before it gets better. It needs to get worse before it gets solved. And that framing's a little bit different.
Well, it needs to get worse where?
In the market.
Exactly. Well, there you go. And right now, what do you do if you can't get an edge? And what do you do if basically every single time you've ever traded on this before, you've gotten burned?
To so many of Americans, Japan is Tokyo. There is a whole nother Japan, and part of it is on the West Coast overlooking the sea to Korea and Russia. That's where our Anne-Marie Jourdain is. She is our Bloomberg G7 finance minister's correspondent after her most interesting interview with the Secretary of Treasury. Anne-Marie Jourdain, the Secretary, is 76 years old. She has bulletproof economic academics as well. And what I really heard today is she's going to stay the course and serve out her term. Is that true?
Yes, that is true. She said this a number of times. She confirmed that with me today. I asked her a little bit of a tongue-in-cheek question at the very end if she'd consider another 4 years if President Biden were to win, because obviously he has relaunched his next bid for the White House for 2024. And she laughed, but she says she enjoys doing the work and she will continue to see out this term. Obviously, her work right now, whether it's in Washington or here in Nagata, Japan, is the debt ceiling. On the sidelines, this is what her peers at the G7 are very concerned with. The risks to the global economy, they're all emanating from the United States right now.
Anne-Marie, you know that each White House has a process of debate and dialogue. Where does Secretary Yellen fit into the debate and dialogue of the Biden 1600 Pennsylvania Avenue?
Well, when it comes to the debt ceiling, of course, the Treasury Secretary is the individual that is going to continuously update us on the X date. She said in my conversation that as we get closer to that June 1st, or as early as June 1st is what she's outlined, that potentially Treasury could run out of the extraordinary measures they've been taking since January, that she will update Congress with a more precise time frame. So her team is going to be obviously communicating all of this first and foremost to the White House. And then, of course, we got a little bit into what happens if there were to be a default, if we go over the X date. Treasury Secretary Janet Yellen was at the Fed in 2011 when the Fed went through these scenarios of what Treasury was doing. And it was under the assumption then, and I've read the transcript, it was under her assumption then that Treasury would service the debt first. She says that she has not yet spoken about these paths yet with the president. It's going to be politically fraught for this administration if there is no deal and they need to decide to pay bondholders or pay recipients of Social Security.
Meanwhile, John was saying that it has to get worse before it gets better. In other words, people have to care more before they can resolve anything in Washington, D.C. Over at the G7 finance minister meetings, how much do they care? How much is this a focus versus people looking past this and saying the same thing that people in the markets are, which is, we've seen this movie before, it always gets resolved?
There's a lot of concern and angst amongst other financial ministers at the G7. And we heard from the German finance minister. He's saying he hopes that Washington makes a mature decision they are all also on the edge of their seat waiting to see how this plays out. And there is concern. When you think about the makeup of this Congress, only about 33%, NBC recently did analysis of this, 33% of lawmakers were here in 2011. They witnessed that downgrade. They witnessed the pain in the market. A lot of these lawmakers are fresh. And Kevin McCarthy has a very difficult line to walk. I think many people are viewing that the negotiations stopped, that the meeting stopped today, is postponed to early next week. They do see that as progress because that means on the staff level, they are working through a number of items before they want to sit down with the principals. But next week's going to be incredibly busy. And for the Treasury Secretary, she will be meeting with bank executives. She said recently she's been speaking to business leaders, but she hasn't spoken to bank executives since January, and she wants to learn from them what is going on, and potentially she wants to put some pressure on them to start calling other members of Congress, because for her, she does not want to even speak out loud the contingency plans. She says there is no good deal unless Congress lifts the debt ceiling.
Anne-Marie, just quickly here, putting those ideas together, the concerns about the banking sector, not just with respect to them getting more excited about the debt default ceiling, but also just with some of the regional banking crisis. How much is the U.S. on a back foot relative to where it has been in the past, these G7 meetings?
Well, the U.S. always wants to lead, especially at a G7 like this. They want to lead when it comes to China. The G7 meeting is really the prep work as well for the ministerial meeting that I'll also be attending with President Biden in Hiroshima. And one thing we know they want to work on is this economic coercion against China. Secretary Yellen has spoke about the work that they're doing potentially on outbound investment. There's supposed to be an executive order. But this administration, the way they confront China, they want to do so in a multilateral approach. It's very difficult to make sure you're corralling all the troops when you come here and they're asking you questions. When is the U.S. going to raise the debt ceiling? How do we know that the treasuries that are the underlying bedrock of the global financial system are going to be paid and secure? It does put them in a very precarious place.
AMH, wonderful conversation. Fantastic job this morning. Thanks for joining us. Anne-Marie Hordern there. Out of the G7 meeting over in Japan, I think, Lisa, you're right to lead on that question. I think to some extent it does undermine U.S. leadership at this kind of level, particularly when the United States appears to be the source of risk at the epicenter of it on several fronts. The debt ceiling debate, one, the regional banking crisis, and I think a lot of people would prefer we did use that word, even if, Mohammed, you are watching, I'm sorry, you don't want us to. But on two fronts, there's two right there, and it's a problem.
Well, and that's the reason why a lot of investors are moving assets out of the U.S. Here's my question. How much is this the source of unease for people, that the U.S. might not be as reliable? How much is this the excuse that they're using at a time of fractured international relationships and a real tension between who to form alliances with, the China kind of alliance or the U.S. kind of alliance?
I think each nation has their battle. And you know, coming out of the pandemic, there's the challenges. I mean, John, the United Kingdom this week has been absolutely bizarre, the number of people that got wrong, the gloom of United Kingdom.
Probably the right word, bizarre.
You know, and it's better as well. And in France, look at Macron, look at the protests in the street. And
brutal.
Yeah, in China with its own calculus. I mean, this is just a bizarre time. And for us to have a highly repeatable, I mean, how many times since World War II have we gone through this ballet? Off the top of my head, I'm going to say 14 times.
78, I think.
Is it? Are you serious? I don't doubt it. I mean, this
I
is
sense
just
when Lisa
absurd.
says a number that she's serious, and when you say it, you might not be. She might cheat guide to the show.
Wally Adeyemo said that 78 times.
Diamond said yesterday, are they riveted by it? And he said no before he went into his statesman stuff at the end, like he did in the annual letter.
Do you want some light humour? Do you remember when Trudeau said he wanted to be the dean, or there were reports that Trudeau wanted to be the dean of the G7 because he was the longest-serving leader? And no one. Can you imagine being a leader on the international stage and you're like, you know, I should be the dean, and everyone just laughs?
Yeah. Wait, no, guys, what's going on?
No, I'm the longest-serving leader of the G7. I should be the dean of the G7. Everyone's like,
Yeah, well, yeah, where's the dean right now? Does he want to be?
Who's your tailor, and why are you choosing grey suits? Yeah, that's what.
That's what you have to ask
That's what
him?
I'd be asking. That would be my lead question. That's why I'm not interviewing him. Let's get you to the weekend. Live from New York City this morning. Good morning. Welcome to the program. Your equity market just about positive on the S&P 500, positive by 0.4%. On the week, lower marginally, trying to take a bite out of that on the S&P. On the Nasdaq, positive by 0.2%. Yesterday, some drama in PacWest, but isolated drama, I would say, did not bleed through to the rest of the market. Looking elsewhere, 2-year, 10-year, 30-year, looks a little something like this in the Treasury market. The 2-year right now, the yield is 3.90 on a 2-year. The 10-year, 3.41. 21 yields a bit higher at the long end by 2 or 3 basis points. Again, no drama. Really the takeaway of the week, things heading in the right direction, maybe for the Federal Reserve, claims starting to break out a bit, inflation moving in the right direction perhaps, and maybe you can draw the conclusion that they are done for the month of June. Others, though, Governor Bowman out there talking up the potential of going again. We'll get to that in just a moment. Let's get to foreign exchange. A break of 109 on the euro against the dollar a little bit earlier in the session. Right now, 109.12. Barely above that level, 109.12, and almost totally unchanged just for you, Lisa.
Thanks.
Again, but we have broken down this week a little bit, Lisa. Yes. Weaker euro story, dollar making a comeback.
It's actually been interesting. I've got to be honest. That's the one pocket of interest because everything else is basically range-bound. I got to say, this market's in stasis. Let's be honest. It's basically
You're saying
no
I didn't miss much.
No, God. I mean, come on. You knew that. It's been really tough.
Let's get to the quote from Kelsey Barrow of JP Morgan Asset Management, weighing in on all of this and saying the following. Here's the quote. Recently released economic data should reinforce the Fed's bias to stay on hold at the June FOMC. More importantly, Tom, the forward-looking indicators suggest the road to recession is already paved. While the Fed can't contemplate rate cuts now, the market can still anticipate them occurring later in the year.
It'll be interesting to see. And, of course, you go to as Mike McKee mentioned yesterday, you get the dots moving around at the next meeting. I believe it's June 14th. And so, the Fed chat just doesn't go away as we go into the year.
You love the dot plot, don't you?
I can't stand it. I wish it would be eliminated.
Dots moving around.
Tomorrow.
What is this, a disco?
Dots moving around, and who knows where Bull is going to land. We'll have to see on that. Kelsey Barrow with us right now, fixed income portfolio manager, JP Morgan Asset Management, briefing Mr. Diamond yesterday as he spoke to Francine Lacroix. I look at the bond market and what I would say in equities, foreign exchange, and commodities. Commodities very weak. Bonds always send a message. What's the message being sent by fixed income right now?
Well, I think the message being sent by fixed income is there is slower growth and slower inflation ahead. And, we continue to look at the yield curve and look at the signal that the yield curve is giving, which is a very inverted yield curve. You have the short rate at 5% now, and you have the 10-year at 3.4%. And it's saying that, things are going to slow down. So historically, what happens, our favorite yield curve is the 3-month bill rate versus the 18-month forward bill rate. Now, that is about 200 basis points inverted at this point. It's the most inverted back to the 90s. Historically, when that starts to get inverted, it's about 12 months to recession. Now, that inverted November of 2022. That puts you in about Q4 for recession.
You and the team have got first rate cut when? September?
We do.
September.
Yes.
Do you have any idea of what they come back to, or is it still too early to make those kind of calls?
We don't necessarily think they're going back to the zero lower bound, but we are positioned long duration, which means that we have to feel that the Fed is going to be more aggressive than what's already priced into the market. So, you've probably heard the expression that, the Fed takes the stairs up and then the elevator down. I like of thinking about it like chutes and ladders, if you've ever played that children's game. Essentially, what we expect is that when the Fed does cut, they are going to be cutting fairly aggressively. And it's not because of the inflation story. We actually already see the inflation trends, the disinflationary trends, fairly well entrenched. We expect to see them over the course of the year. What's going to have to happen for them to actually cut rates is going to be to start to see cracks in the labor market. So you mentioned continuing claims. Continuing claims really, I think is showing an important trend. So if you look at continuing claims year over year, it's up 25%. That's never happened outside a recession. That's going back all the way to the 1960s.
But is that enough for cracks? I mean, honestly, this is really the question. A lot of people are saying, okay, this is what the Fed's been looking for. Maybe it's a little bit above. It still is pretty low relative to history. It's coming off an incredibly historically low base. How much is this enough of a crack, or does it have to be an acceleration in the regional banking crisis? Does it have to be commercial real estate? Does it have to be private equity?
Yeah. So what we're trying to do right now is we're trying to build a ledger. And there's things on both sides of the ledger. There are things that are saying the expansion can continue. And I think, the biggest thing there, is some of the data still in the labor market. We're still growing jobs around 200,000. That's well above the break-even rate. And as a result, the unemployment rate is still falling. But the number of things on the other side of the ledger that are suggesting that we should be slowing is just building and building and building now. And it's really allowing us to, increase our confidence that as bond managers, what we want to be doing is staying long duration, adding curve steepeners to portfolios on opportunities, where the curve may tactically flatten, and staying very up in quality in terms of our credit quality bias.
This is something that we saw with the fund flows over the past week. Global bond funds had their 7th straight week of inflows, the focus really being on developed market debt. Equity flows were interesting, and high yield I put in there. There were outflows of the U.S., there were inflows for the rest of the world, particularly China. Do you agree with this assessment? The U.S. is the weak spot, but globally, risk is a little bit more appealing.
Well, I do think that the stories are not the same, particularly on the central bank side, on the inflation side. You have Europe, inflation is really not showing any improvements. UK, not showing any improvements in terms of inflation. They are a little bit behind in terms of the monetary policy cycle. But I'd actually point to something more global, which is the commodity market. We were looking at the copper-gold ratio yesterday. That's actually back down to where it was 2 years ago. So, I think that the commodity market is telling you that there may be a little bit more stress globally in terms of demand. Those investors are saying, I'm not sure there's as much demand for all of this industrial product.
That tells you more about lower growth. Is that the call there? Is that what you're seeing?
Yes.
So lower yields at the long end, rate cuts to be priced in at the front end. Where does the debt ceiling fit into all of that? When you start talking about curves and mention T-bills, I'm like, how much of that at the front end of the curve is just driven by this mess right now in Washington?
So definitely there is distortions in the T-bill market as a result of the debt ceiling. I mean, you have 5 trillion, 6 trillion nearly in assets in money market funds. And they're all being moved around to try to adjust for this potential stress, this X date that Chair Yellen is, or Treasury Secretary Yellen is putting on June 1st. In our mind, ultimately, this is just another stressor at a point where, the system is fairly fragile. And what we're thinking about is kind of these unintended consequences. And there's a lot of operational risk that people don't understand that's going on in the background. The Treasury market is the backbone of the financial system. It's not just that, we talk about is the yields going up, is the yields going down. It's used as collateral. It's used as the safe haven across the world. And so if you have a bill that is going to mature during the X date and we do run through that X date, there's a lot of questions about how things are going to work. And you mentioned, Jamie, here at Bloomberg yesterday, he's talking about the war rooms. That's what everyone is looking at now, is setting up those war rooms.
Take us inside your war room. Can you describe what that day might look like? I won't ask you for the probability that we're going to see that day. That would be unfair. But describe what you think that day might look like. I own an at-risk maturity, whatever that one might be. That day comes, we go through it. What happens? What does that look like?
Well, I do think that the money market funds are preparing for this, and that's why you're already seeing the distortions in the market. So, the investors that are needing to adjust are already making those adjustments now. But I do think, of course, the broader sentiment in the market, if we were to pass the X date and not have the money that we needed to continue to pay bills, would be a fairly stressful situation for the broader markets. I think credit spreads would be widening. I think equity markets would be falling.
The Treasury's rallying?
And I think Treasuries will be rallying, similar to the experience we had in 2011.
That's where I want to go. The U.S. aggregate total return index needs to go up 12% in price to get back to where it was before all this storm and thunder. Great. How long is it going to take for people to get price up, yield down, so they recover from the bond debacle of the last 2 years?
Well, the good news is they're already getting some of that.
They're
right?
getting some of it. I'll give you that. But
yeah.
come on. Is it quarters, or are you and Bob looking out years to see a price recovery in bonds?
Well, we've looked at how bonds perform once the Fed has paused, and bonds handily outperform cash once the Fed has paused. So we are looking at a situation where, this is the time to get invested. This is the time to lock in the yields, get them now, and benefit from the capital appreciation. Once the Fed starts hiking, we expect that in Q4.
So by duration on what we believe is the last hike seems to be the call, right?
That's it.
Kelsey, wonderful to get your view on things. Kelsey Barrow there of JP Morgan Asset Management. TK, going into this mess down in Washington, D.C., and I hate to disappoint you all, it's just getting started. We're literally in the foothills of this, Tom. We've had one round of conversations in Washington.
Right.
The next meeting's been delayed. This is just getting going.
Yeah, you get to go the process. We mentioned this yesterday very briefly, I think, and probably not enough, and we'll mention it much more into June. There's going to be a time on a given Monday, Tuesday, where they're going to tell these clowns that by Thursday, Friday, your constituents aren't going to get their Social Security check. Whole dialogue changes. Right there. Changes. All the politics drifts away. Your constituents aren't going to get the cut check or deposit into their bank from Social Security or name another institution. Whole dialogue changes.
Which is really sort of the subtext to what Janet Yellen was saying. It's either not paying, not making good on full faith and credit in the U.S. or Social Security checks. Guess which one they're going to go for. Social Security checks would be the political angle, but not the financial angle for the U.S. They're going to make good on the full faith and credit. They are not going to necessarily make those Social Security checks.
And I've been dying for you to get back, John, because I want to talk about the shock of the United Kingdom, positive GDP and that. But the answer is there's always surprises out there. And to your point, John, on process, there will be surprises within this debt ceiling debate.
Always are. Do you know what I was surprised by in the last 10 minutes? Chutes and ladders. Is that what you called it?
Yeah.
It was snake and ladders.
No, it's a JP Morgan.
Really?
We were tough for kids. We were tough for kids.
Okay,
snake and ladders.
Really?
Were you scared of snakes? Is that why they renamed it over here?
No, it's just that it's a childhood game. You go on ladder, shoots, slides.
And
which is why it's like physical.
But what's great about this is that I've heard Ferroli do this at JP Morgan too. I think Ferroli once mentioned the game of Risk.
It's a slide.
No,
you can't slide down a snake.
You don't want to land on a snake.
But then you slide. It doesn't make any sense. But literally, that's just not physically.
They just make us tougher in the UK, Brahma. That's what it's about.
It just doesn't make sense.
You know what's great about this? Diamond mentioned Parcheesi yesterday.
What did he say?
He was talking about his annual letter, and he said, he's looking at global risks and our Western alliances, and he brought up Parcheesi.
I am scarred by both of those games, having played them for hours upon hours during the pandemic, during rainy days with the kids, trying to keep them off screen time. And then I was like, here you go, guys.
How does Monopoly go down at your house?
Oh, I hate Monopoly.
Because at mine, it was brutal.
The side deals?
It was brutal. We'd run a book on a side. We always would.
How long would it last?
It could go on for a long time until someone flipped
the
board. And that's usually how the game ended.
It's
Pro
always
tip,
how it does.
Never own the greens. Pennsylvania Avenue will kill you. Pro tip.
Thank you, Tom.
Coming up next, Evan Ryan of JMP Securities on the banking sector. Your equity market this morning, positive 0.4%. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Aides for President Joe Biden and House Speaker Kevin McCarthy continue to hammer out details on the debt ceiling after a meeting between the two leaders and other congressional members set for today was rescheduled until next week. Sources tell Bloomberg the postponement is a sign that staff talks are showing progress. Lawmakers are trying to avoid a default on payments. Finance chiefs from the world's rich economies are set to propose a new partnership on supply chains. Bloomberg's learned it would be open to other nations and will require them to have minimum standards on human rights and environmental policies. The G7 finance ministers and central bank chiefs are meeting in Niigata, Japan. Donald Trump is appealing the verdict of a New York jury that found him liable for sexual abuse and defamation. E. Jean Carroll claims that the former president raped her and then defamed her by calling her a liar. Trump lawyer Joe Tacopina says that the jury should not have been allowed to hear the so-called Access Hollywood tape. More bankers leaving Credit Suisse in the wake of its forced sale to UBS. The latest departure involves 8 senior bankers moving to Banco Santander. Now, among them, Steve Geller, the head of investment banking and capital markets M&A. The moves are seen as a sign of how Santander is expanding in the U.S. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We need to finish the bank crisis. We've had uncertain policy on mergers, this First Horizon deal, I think we have to assume there'll be a little bit more. So, whatever the FDIC, the OCC, the Federal Reserve, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking, not be surprised constantly, because some of these things have been known about for quite a while.
Really nice exchange with Jamie Dimon, the JP Morgan Chase chairman and CEO, together with Francine Lacqua over in Paris, France. Just a fantastic exchange. If you can find it on Bloomberg.com or on the Bloomberg terminal to watch it in full. Live from New York City, welcome to the program on TV and on radio. This is Bloomberg Surveillance. Your equity market still just about positive, just off session highs. Equity markets right now positive by about 0.4% on the S&P. Yields just a little bit higher too, up by 2 or 3 basis points on a 10-year, 3.41. Earlier on this morning, the euro against the dollar, a break of 109, 108 handle very briefly.
We did get a 108. I didn't know
We had
that.
a 108.
Yeah,
I can confirm that. The low of the session, 108.99, just off that level right now, Tom. That currency pair just about unchanged.
John, I want to review two-year yield. We had a 405. And then, boom, down to 385, I think 386, and right now 3.90 on the two-year yield. And that goes to what we heard from J.P. Morgan moments ago, this idea of global slowdown, oil coming in a little bit, and copper off LME to me is something worth watching.
And some data too, jobless claims. Jobless claims just starting to break out. Now, historically, you can say at these levels, not a big deal, but I think we're interested in the direction of travel and a change, and you put that together with CPI, then that's contributed to a move lower in yields in the last 48 hours or so.
Maybe Jamie Dimon was the most important interview of yesterday. Right now, I'm going to suggest for those of you into the weekend on our banks, Devin Ryan is the most important interview of the day. He's with JMP Securities, a Citizens company. These people are West Coast, and they're very, very good at banking and technology. Devin, I want to take a broader view. Lisa and John want to go narrow. It would be real simple. I look at the future of your world, and what I see is a struggle for scale. I don't understand how smaller banks get margin efficiency. Forget about net interest margin and all the econobabble. Is this going to be a battle for scale in the next 2 to 3 years to provide shareholder return?
Hey, good morning, Tom. I think you're right. I mean, scale in banking has been important for the last decade. I think it's becoming more important, and that's why you've seen consolidation. We've had thousands and thousands of banks consolidate, but we still have over 4,000 banks today. And so there needs to be more consolidation. Unfortunately, some of the recent developments, I think TD, First Horizon, a little bit of a negative for the consolidation case. It's more challenging.
Right.
And so absolutely, it's a key point. But I think the key here is let's not forget what's driving this action. I think we're in a little bit of a negative feedback loop right now with deposits and uninsured deposits. And that's really key that the industry figures that out, because you're seeing declining share prices driving deposit movement, even when there's really not anything dramatically changing fundamentally.
Lisa, this is really important. Didn't come up with Mr. Dimon yesterday, but everybody of a certain vintage has tattooed to their brain the phrase E.F. Hutton. E.F. Hutton went down in flames with George Ball because they couldn't find scale, and particularly they missed technological investment, and one day the party just stopped. And I really wonder if we go from 4,000 banks to 3,000 banks, is that going to be enough to keep scale so people keep investing?
And this is something that we are seeing with some on the margins, trying to parse out the ones with scale, the PNCs, the U.S. banks of the world, rather than some of the smaller cohorts. I'm curious, Jamie Dimon did blame short selling as part of the problem, saying that the U.S. government should investigate short scale sellers to some degree. Do you agree?
Yeah, I think, selling, whether it's regular selling or short selling, the industry is mired by a lot of uncertainty right now. And, banks are supposed to be boring, and that's why a lot of investors invest in them, that there's kind of a slow and steady return. And so whether it's sellers or shorts, I do think the industry is effectively being attacked. And there are solutions. As I just mentioned, we need to get the uninsured deposit issue ring-fenced, and there's solutions to do that. And so, potentially banning shorts is something that could relieve some near-term pressure. There's other provisions within Dodd-Frank that would allow short selling to be more transparent. And so that's something else that could be proposed here and pushed forward relatively quickly. But I think that is kind of not getting at the root of the problem here in the banking space. It's really, in my opinion, uninsured deposits, and they need to find a solution for that. And there are solutions that are available to the to Congress and to regulators.
But even as we put that on the table, it doesn't seem as though this is necessarily a crisis of confidence of being able to get your money back, right? This does seem like there has been some sort of insurance policy that is backstopping where people's money is going. There is something bigger going on. And I do wonder what you say to this idea that perhaps we've gotten to a place where, yes, it is going to shrink. And yes, maybe private equity is going to take a bigger role as they try to push to have some sort of loss-sharing agreements with the government, be more involved in some of these sales.
Well, I think it's a complicated situation, but the law sharing, the government stepping in, I think is a temporary solution. We need to find a solution that puts the banks on healthy ground. The small mid-sized banks are key to the economy, make up over 50% of commercial loans, residential real estate loans, almost 80% of CRE loans, and so. I think having a broad and healthy banking system that's not consolidated into 4 companies really should be a goal of regulators, should be a goal of legislators. And I think they do care about that. But you need to get, again, kind of going back to the same point, the root of the issue, which I think right now is, this uninsured deposits. Of course, there's some yield-seeking behavior. Of course, there could be credit concerns, but that's a healthy conversation on banks. But that's not the key driver right now of this recent turmoil, in our opinion. It's much more the uninsured piece, which is driving the stock prices down, and that's the negative feedback loop that we spoke about.
Taking a step back, Devin, there's a theory out there that the banking system issues that we've seen in the U.S. is one reason why people see that the U.S. is less attractive as an investment proposition, and they're going elsewhere. Do you think that there's validity to this, that the banking fissures are actually weakening the U.S.'s international profile?
I disagree with that. I mean, listen, the U.S. system is the deepest capital markets in the world. Companies and individuals continue to try to come here and put capital into our system. So I don't see that changing. And near term, this is a hiccup. And as I mentioned, there are solutions that have existed before. There's programs the government has put in place to fix some of the issues that are re-rising now. And also, we are in a slowing economy, and it's a slowing economy in the U.S. It's a slowing economy internationally, and financials in that backdrop, banks in that backdrop, generally are not the first place that people look to allocate capital, and I think that is playing into the recent stress. But that's not, again, the key thing here. The key thing, in our opinion, is around uninsured deposits and that negative.
Devin, allow me to jump in because you've said that a few times. Is that the problem at PacWest? PacWest have got more than 70% of deposits insured. Is that really the problem at banks like PacWest?
Well, I think the answer is yes, just in that we've already seen the money move. And so once you're in the headlines, the negative feedback loop starts. And so even though the fundamental story really isn't changing, there's not a new update from month to month, as the stocks have already moved and you've already seen the deposit movement in an accelerated way, investors or shorts continue to push on those individual names. And so what we've seen in recent failures is there's no relief for equity holders. Equity holders are wiped out, right? So until equity holders have a way to kind of push back or there's a bounce back in stock prices, vulnerable names keep getting pushed. And so you need to address, again, I think the root issue so that we take some of these names out of the headlines and you don't go to the next bank or the next bank after that. And I think that's key. Certain banks have already, had so much headline pressure that it's a challenging moment. But we need to make sure that we don't go down the line here. And I think that is addressing some of these issues that again, can be addressed.
Devin Ryan at JMP Securities. Devin, thanks for that. Thank you very much.
Thank you.
Certainly that was the origin of these issues, the stress of the last couple of months. I think the conversation, Lisa, is whether that's shifted and morphed into concerns about something else.
Profitability among those things, which doesn't really get helped with the insurance. I mean, that's a scale issue, but it's also an issue of rapidly rising rates and a whole bunch of assets that were priced out at a very different rate with possibly negative real interest margins.
Somebody had a chart out just in the last 12 hours, 3-month T-bill. And again, it's all debt ceiling touched, I know. But, there's a point where you look at this moonshot in short-term yields. I mean, what does it do to the average bank removed from all this? They didn't sell jumbo mortgages for 1 or 2%. There's a point where you get overcome by events.
Well, you've got to acknowledge that yield-seeking behaviour is a part of the dynamic of the last month or so. without a doubt. I don't know why short selling always becomes the bogeyman. It's such a distraction.
No, I totally
It's
agree
always
with that.
such a distraction.
Okay, what do you think the trading desk said to Jamie Dimon after that? Whoa. Hold on a second.
Credit to him. He did back it up by saying that he doesn't think that that's the major issue right now.
And in fairness.
And ultimately, that was poor management of some institutions.
Fair. I think it's going to be interesting to see whether they actually go through with that. They always say this.
I know.
It never works
it's
out.
It's the bogeyman. It's like, short sellers did it.
Yeah.
It's always, some mean person in the corner.
It's true. The troll in the corner.
With monetary policy acting with the lag, we have to assume there are more shoes to drop here and more banks to fail.
What I'm more skeptical about is the decline in inflation.
Fed cuts being priced in right now far too aggressive.
The move for all the central banks getting from 5 to 2 is where the real challenge lies.
I do think that we are going to be looking at, again, slowing inflation, a slowdown in the economy, most likely a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Solution. You pay Congress in T-bills this month. It's that easy.
They would
At-risk
love that.
securities. And then let's see if they deal with things and you get paid on time.
You're getting real yield.
Beautiful.
Suddenly that would be a positive thing.
Well, only if the government pays, right? There is an incentive to get over the line.
I mentioned this in the last hour. I think this is absolutely critical. They're going to go, I'm sorry, you're in the X district of Ohio. Your constituents aren't going to get their Social Security check. Problem goes away. Just
Instantly.
like that. Instantly.
From New York
Instantly
City
goes
this
away.
morning. Good morning to you all. Welcome to the programme on TV and radio. This is Bloomberg Surveillance. Your equity market just about positive on the S&P 500 by 0.4%. In the foothills of a big debate about the debt ceiling. There was meant to be a meeting today between the Speaker of the House, McCarthy, and the President of the United States, Joe Biden. And Tom, that meeting has been pushed back, and we are informed that staff-level talks are ongoing.
Staff-level talks, and they're important. There's a lot of complexities here in that, but I think they're wide apart. Greg Valliere, who's attuned to this as anybody at AGF Investment, says, you know what, it's just what it is. There's no agreement at all, and they have to wait for a catalyst, and the catalyst comes from the calendar. They got to tick ever closer to June, whatever.
Whatever it is, towards the X
We're
date.
nowhere near that.
Might be June 1. Who knows? Yeah. We're going to do a ton of scenario analysis that may turn out to be absolutely pointless, Bramo. Let's see if it is different this time.
Wait.
Is it different this time?
Well, no. I mean, that's basically what everyone's saying.
How much ink is going to be wasted over the next couple of weeks on scenario analysis of a bunch of things that just don't materialize?
Are you trying to get me not to show up to work? I mean, honestly, this is really what everyone's dealing with, which is a reason why you're not seeing that risk premium built into equities, because people are like, why waste my time? Why waste my paycheck on your crisis that you are going to resolve at the last minute? Why make me part of your theater?
Here's the worry. The VIX is 16 level, 4161 SPX, 33,500 Dow. The NASDAQ 100 to me is an act of God, 13,500. John, equities have been like a rock given all the scenario uncertainty.
Nothing's happened.
Yeah.
Basically, it's such a tightly defined trading range of the year so far.
It is
3,800 to 4,200 on the S&P 500. I'd go one step further. Have a look at the two-year yield.
Exactly. That's where
the
we're
two-year yield's not really done much either.
It's
this
been
market
collared.
hasn't done much.
It's been collared. You missed this yesterday, but I did the chart, and it's like 380. If you get a 379, 378, maybe that gets you outside the zone, yield lower, price up. We're not there yet. We're still in the zone.
It's not a comfortable stasis, though. This isn't a relaxing time for investors. And this is what I've really noticed. It's not that people are saying, OK, we're happy with our investments. They're sitting on their hands. They're waiting for a catalyst. And that's what makes me think we could be in for some extreme motions once there's a catalyst, or else we're going to do this for the rest of the year.
We're playing chicken with the S&P 500. It's just, it's ridiculous, but we're doing it again. On the S&P at the moment, Bramo, we're positive 0.4% on the S&P this morning.
And we're waiting to play perhaps Chutes and Ladders if there is some sort of catalyst. Today, 10 a.m., we get the University of Michigan Sentiment Survey. I am looking at the headline number, which is expected to come in softer, but possibly more important, we are going to get the longer-term projections, given the fact that last time they went up for the 5 to 10 year sector. To me, this is interesting. People are getting used to higher inflation, and that has got to be really concerning. Today, perhaps we get a sense of just how concerning that is. We get Fed Speaker, San Francisco Fed President Mary Daly, who will be speaking at a commencement address at USC. I am curious to see if she addresses what happened at her own bank and the oversight there with respect to Silicon Valley Bank. I mean, that's what everybody wants to know. We haven't heard a lot from her. And 7:45 p.m. Eastern, we have Fed Governor Philip Jefferson and St. Louis Fed President James Bullard giving some insight. Again, it hasn't been particularly illuminating to hear some of the comments because they're in the same uncertain place that we all are. And this weekend, those meetings between G7 finance ministers continue. through tomorrow. Real big question about what's happening with the debt ceiling and what that does to the U.S. clout. Also, though, the regional banking situation and how much some of the pain that we're seeing there is raising issues for global financial stability, and how much Janet Yellen really has to speak to that.
Peter Scheer with us around the table, the head of macro strategy at Academy Securities. Pete, good morning. Let's start with this one. Who's more complacent right now, this market or politicians in Washington?
I think the politicians in Washington, because this market, I think, is trying to figure out, do we get some sort of soft landing? Does this work out? Do we get through a bunch of these problems or not? And I think that's where we're on, this potential for a large gap either direction. I think the people in D.C. have kind of lost the focus. There's plenty of other things we should be focusing on other than the debt ceiling, and that's just a time sink at this point.
We've got copper rolling over. I look carefully at the Bloomberg Commodity Index. It's good mathematics, and it's not a pretty chart. Your firm has a wonderful Pacific Rim study ongoing. What do you see there? Is it real slowdown?
Yeah, I think China is having some troubles, but I think even beyond that, I really sticking to this theme that we're going from made in China to made by China. Where across the globe, China is now trying to compete with our products, compete with our companies more than they ever did. It's something we're hearing from companies. We're running into people who are losing contracts denominated in the Chinese currency. I think that's a long-going play. China's still struggling, but it's going to be at our expense as well.
With the military exposure of your firm, can you invest in Taiwan even with the United States committing to 3 and indeed 4 military bases in the Philippines? Is Taiwan uninvestable?
Yeah, so I think our firm has a pretty strong view that China is not going to invade Taiwan anymore anytime soon. The defenses of Taiwan are very strong. China's learned a bunch of lessons from Russia. Having said that, there is this erosion of confidence and how we're going to be able to deal with Taiwan over time. So I think we've got to be careful there.
Right now, a lot of people are cautious. We are seeing this sort of volatility come down, people getting a sense that they're just waiting for Godot, waiting for some catalyst, waiting for a sense of which direction we're going to pivot in. What are you looking for to really represent that catalyst?
So I think people have been patient. They latched onto the AI story, so that's been what all the bulls have gravitated to, and it's an interesting story. There's definitely some run room there. For me, the catalyst is what happens with the banking. Do we really see this slowdown? And when we look at that, the SLOOS report, which we never really pay that much attention to.
We do now.
We do now, apparently. But I think really the important thing there was it's a demand side issue, right? There's lack of demand for loans. It's not just that the banks don't have deposits. So I think we're seeing the economy slow down. Jobs data, a lot of it's still good. You're seeing little bits and pieces, like we're starting to see a tick up in unemployment claims. How good is that when every headline really is about layoffs? So I think there's a slow bleed. It's slowly playing into the economy, and I'm looking for either confirmation for that or that somehow we've avoided that problem.
Okay, so what is that problem, right? Because things are slowing down, and this is by design. And this is sort of the difficulty where people are saying, that's happening. And it's a good thing. Yes, we're seeing a rise in unemployment claims. This is exactly what the Fed wanted. Yes, we're seeing deceleration. Okay, great. And guess what? Companies are actually more profitable because margins are increasing. They're passing along those prices. When is it a negative?
I think it's already a negative. I think one of the things is we're addressing something that was really a supply chain shock, and we're trying to use monetary policy to address the supply chain shock. So that was a problem. So we're doing the wrong things, and I think we're forgetting about all these lags, right? It takes months and months from the person who gets let go by the time they get their severance package and all these things to hit the economy. I think the rate hikes from last November haven't even really hit the economy, right? People rolling over their car loans. Everyone I talk to who's looking at releasing a car after their 3 years, they're shocked by the price. They didn't have to deal with that a year ago if their lease wasn't coming due. So I think that lag is something we've all forgotten about in this real-time economy.
One of the quiet charts of the week were bankruptcies in the United States. I was thunderstruck how they're elevated here.
It's a process. I think we're all waiting for this event. Boom. It's a process. And you can put the pieces together. The other issue that I think a lot of people have got right now, Pete, is that we had excessive monetary easing for so long, for an extended period of time, way beyond the time that we needed it. And then the Federal Reserve had to play catch-up, not front-loading. I hate that language. It wasn't front-loading, it was back-loading. They were late. And we're trying to work out what the price is we've got to pay for that as market participants. Is it just a 30% move on the NASDAQ last year, or is there more to come?
I think there's going to be more to come, and I completely agree. They were very late, which is ironic. Even as they were discussing rate hikes, they were still doing large-scale asset purchases into January 2022, so they missed a lot on that. And when I look at the banking crisis, or whatever you want to call it, to me it's very simple. Basically, during COVID, banks went from $13 trillion to $18 trillion. So in 2 years, they took in $5 trillion of assets, which is much more than the $500 billion they normally take in, at the exact worst time to find good investments. So it would not be surprising to find that some percentage of the banks were very conservative and dealt with it well, and some maybe got a little bit aggressive. And I think that's what's playing out right now. This no longer has anything to do with uninsured deposits. It's about what did banks do with the money when they took it in, and what are they going to pay people to keep the deposits? Because I don't think anyone's really worried about their deposits defaulting. It's now, am I getting a fair rate on that? And what does this bank own on the back of that?
Well said, Pete. We could be facing, what, years of some of these banks just being quite unprofitable for a long time.
Yeah, I think that's right. I think it's going to be a unwind period. And my big concern, it's a tail risk. I don't think it happens, but the tail risk is as one comes through and their balance sheet becomes available for sale, it drags prices down, bringing another one into that leg. So that domino effect. So I think that's what we've got to be working on. The Fed's got to be very careful about hiking rates. They've got to be very careful about causing pressure on bond prices, because that will, basically create that domino effect.
We'll be talking about this for years. Years. Mortgages sold at 2%. We'll be talking about this for decades. People aren't going to sell their houses.
Well,
we know this.
The running joke's been, for a lot of people, certainly last year, your best asset was your mortgage. So it's like crazy to think about that way.
Who's going to sell their house? Who on earth is going to sell their house unless they're forced to move for a job or something out of their control happens? Who is voluntarily going to sell their house with a 30-year mortgage on it with a rate of 2 to 3%?
And so that's been one of the ironies of this whole thing, right? The home builders are doing well because they can build a new house that someone has to move in, because there is the supply shortage because of this weird phenomenon about mortgages.
Well, and then there's this question about financial engineering, where people are going to basically just pass along those mortgages. I don't know. Taking a step back, I just wonder how much this is normal, right? That you get a washed out in banks, and how much is different. How much is this something that is a unique distortion?
I have no idea what normal is anymore. What's normal?
We don't know what normal is.
We've had a distortion for like the last 10, 15 years.
This was a calculus exercise. The first and second derivative of the rate change, and Peter was way out front on this, was truly historic. If you get yields coming back in a Steve Major way, in an Ed Hyman way, in a David Rosenberg way, does this self-adjust price up, yield down? No one's looking for that. No one's looking. You talk 2 to 3% mortgages. What if you get back to a 3.6% mortgage?
And I would just add the one thing, right? We never experienced these large-scale asset purchases or QE until 2008. I don't think we have any idea how those really affect asset prices or not. So I think people like to try and convert, how much QE is or QT is a basis point. I don't think we have any idea. And I think QE and QT go much more directly to asset prices.
Right.
And you keep looking at the Fed balance sheet and the stock market.
Steve Rasciuto's heated about this at Mizuno.
Steve's
he
great.
says, just stop it now.
You know what normal is? It's when you entered the industry on Wall Street. Whatever date that was.
Exactly. That's true. Very true.
That's what you believe. Or when you first got your mortgage. I was speaking to someone at the airport the other day.
Totally.
John, let me tell you about the 80s. just like what I had to pay a month. It's always the same.
Can I say thank you?
Sure, of
I
course.
had no idea about snakes and ladders.
Oh,
I had
didn't you?
no idea.
Oh, there you go.
No idea.
It makes no sense.
It's history. It goes back to the India, the Raj, all that.
Did they slide down snakes back then?
No, but they're scary, and that's why they changed it to chutes in America in 1943.
Too scary for the kids.
1943.
They make them soft here.
Ferro shows up. I learned something every single Friday.
They're going soft.
I'll send the promo boys over to the Ferro household.
2 days this week. You should come in.
This is what Governor Youngkin was talking about.
Oh my gosh.
This is what he was talking about.
Shoots and ladders.
What's happening in education these days.
Shoots and ladders. Stick some snakes on them.
That's a conversation for another time. Peter Chair of Academy Securities. Thank you, sir. Equity markets positive 0.4%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit that was set for today. And that delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. McCarthy says the president will meet with him and other congressional leaders next week. House Republicans have passed a symbolic border security package. The legislation would ensure fewer people could claim asylum in the U.S. and lock more migrants in detention facilities. It has no chance of passing the Democratic-controlled Senate. The bill's passage came on the same day that pandemic-era border restrictions ended, ensuring an increase in migrant arrivals. Twitter appears to be getting a new chief executive. There are multiple reports that Elon Musk is in talks to hire the head of global advertising and partnerships at NBC Universal to be the social media platform's next CEO. Linda Yaccarino joined the company in 2011 after nearly 2 decades at Turner Broadcasting. Musk has said he'll become Twitter's chief technologist. I'm Lisa Mateo. This is Bloomberg.
the only good outcome is one in which Congress acts. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills. If Congress fails to do that, it really impairs our credit rating. We have to default on some obligation. That's something America hasn't done since 1789, and we shouldn't start now.
We'd have to default on some obligation with very little transparency on what that obligation might be. Janet Yellen, the US Treasury Secretary, speaking to AMH in Japan at the G7 meetings. Live from New York City this morning. Welcome to the program and good morning. Your equity market positive 0.4% on the S&P 500. A lift to close out the week. Let's see if this sticks going into the weekend. Futures positive, yields higher by 3 basis points, 341.96 on a 10-year. Tom, has there been a discussion between the President of the United States and his Treasury Secretary about which obligation that might be?
Yeah,
what is the hierarchy?
We don't.
Of things?
I don't
what
think,
are the contingency plans they've got in place?
To the conversation last hour, John, I think you're dead on. We don't really know the process between the Secretary of Treasury and this president. I'm really unclear on the back and forth and how it works, given all the other advisors in the White House. With Ron Klain, it was easy. Ron Klain ran things. But right now, I'm really not sure.
They are clearly unwilling to be fully transparent about this. For negotiation purposes, from my standpoint, this is why they don't want to talk about so-called hypotheticals. It would be ridiculous to me, just the idea that you don't have a Treasury Secretary and a President that have had this discussion, Lisa. I can't get my head around that. That would be irresponsible as a policymaker not to have these contingency plans in place, or at least not to be having these discussions weeks away from what you believe might be the X date.
I'm sure they are. If they're considering using the 14th Amendment of the Constitution to potentially just keep on paying and keep on going, they are having these discussions. They are making these contingency plans. They don't want to talk about them, though, and we're going to basically have to be used to that. The political theater that happens outside, and then the real talks that happen in the room.
A brief on-site and into the weekend with us, Anne-Marie Horton, our Bloomberg Washington correspondent in Niigata, Japan. This is on the west coast of Japan, away from Tokyo, but with a focused G7 finance ministers meeting. What I'm absolutely fascinated about, Anne-Marie, is we have a Secretary of Treasury exceptionally experienced in economics and labor dynamics. She basically invented the word slack within the modern economic jargon. We also have a president with years and years of legislative experience. That's a powerful combo. How will President Biden and Janet Yellen, when you get back to Washington, how will they move this process given all their experience?
Well, we know from Secretary Yellen what she spoke to me about here at the G7 is that when she gets back, she will be meeting with banking executives. What was interesting, and says recently she only spoke to business leaders in different sectors of the American economy. She hasn't spoken to banking executives about the debt ceiling since she first put out that letter in January. And she wants to learn from them about their angst. Obviously, we know Jamie Dimon yesterday told Francine Lacroix that he has set up a war room. And then you have the President of the United States, who was only going to be there for half the week, because then he's coming here in Japan to meet with leaders at Hiroshima for the G7 ministerial meeting. So the negotiations right now on the political front are happening with his staff and the legislative staff of Speaker McCarthy. That is really who is going to be able to hammer out this deal. And that's why likely part of the reason this meeting today, that was supposed to be today, is postponed. They think they are making some progress on the staff level before they sit down with all the principals. But as you said, Biden really likes to tout himself as this epic deal maker. Spent years in the Senate. He was the one that worked with Mitch McConnell when he was vice president to get a deal done. And the Treasury Secretary has great relationships with those on Wall Street. Can they finesse this? Her putting some pressure on bank executives and him potentially being able to get a deal done? We have to wait and see.
In your discussion today, Anne-Marie, between yourself and the Treasury Secretary, did you get a sense in any way, shape or form of what the contingency planning might look like if we go through the so-called X date?
I didn't, because we pressed her on this a number of times, because there is this assumption that she herself was in the room for that in 2011 that Treasury would prioritize debt payments. They would make sure that Treasury principal, securities, all of that was being paid. When I asked her about this, she has yet to discuss with the president those contingencies. Something will have to default, she said. But it is unclear at this moment if that is going to be whether or not Treasury is going to service the debt, which would obviously be quite catastrophic for the global financial system, or things like social service recipients, individuals that are on Social Security, individuals that get a paycheck from the government. For this president, it's going to be very politically unattainable for him to want to pay, say, Chinese bondholders and not those Americans that are waiting for their Social Security check.
Anne-Marie, one of the discussions, in addition to the debt ceiling, in addition to financial stress, has been China. And just quickly here, there is this feeling in the market that perhaps there's a little bit of a mending of ties between the U.S. and China with a number of meetings and outreaches. What's your sense about Janet Yellen and whether she plans to go to Beijing, who she plans to meet with, and what the timeline is?
So I think off the heels of this meeting we've learned about from Jake Sullivan and Wang Yi in Vienna, 2 days they sat together, potentially can open up the sequencing, as Secretary Yellen described it to me, of U.S. officials going to Beijing. She says that she will go at the appropriate time. She told the Financial Times a month ago that she was waiting for her counterpart to be replaced in China. It was Liu He, and now it's Hu Lifeng. And the issue is the counterpart has been in place for weeks, and she has yet to even speak to him over the phone. So there's been no contact yet from, on the Treasury level, the highest individual in Washington and then the highest individual in terms of finance in Beijing. But she still says she plans to go. But I thought it was interesting they have yet to even have a phone conversation. This is part of the angst you hear from other countries. They want to make sure that the two largest economies in the world are communicating. And at this moment, those conversations have been fraught, but potentially on the heels of this Vienna meeting with Wang Yi and Jake Sullivan, that can open up doors for more conversations between Secretary Yellen. Also, Gina Raimondo, the Commerce Secretary, says she plans to go, as well, of course, Secretary of State Antony Blinken, who was supposed to go but then was postponed because of course, that alleged Chinese spy balloon.
Mate, just to wrap things up, TK mentioned this in a previous hour. Got a bunch of political leaders with problems at home. Not just the President of the United States, as Tom indicated, also the French leader, Emmanuel Macron, with the riots in Paris over the last few months that he tried to distract us from that speech. Do you remember that?
Yes,
that interview, rather, with Politico. Yeah, great interview. We'll talk about that another time. MH, what can they agree on at the G7 level? Who's in a position of strength?
Yeah, it's a very interesting point because you have the German finance minister coming out and saying that he hopes Washington makes the mature decision. Everyone here is concerned about the debt ceiling in Washington. And for them, that's one of the biggest economic risks to the global financial system. So at the same time as the United States is trying to shore up their allies as they go after China in a number of economic ways, the latest is going to be about outbound investments is what they want to focus on in Hiroshima. It's difficult when what is front and center and top of mind of every single leader here is whether or not the U.S. is going to be able to pay its bills in a month.
AMH, great to catch up. Tremendous conversation. Anne-Marie, one of the hardest working people I know in this business. Just fantastic. With Janet Yellen a little bit earlier this morning.
You can point out the romance of flying to the other side of the world for 6 hours or 8 hours or 12 hours. I've done it. It's no fun. I mean, the romance, there's just brutal.
Nothing romantic about it, Tom.
Brutal. Absolutely brutal.
Is that your idea of romance?
No, I think she's got
explains a lot.
She's off all next week.
Is that it?
No, it's like great. It's like, I'm in Japan and airport, car, hotel, car, airport. I went to Japan.
Squeeze some Yellen in between.
Yeah.
Nice.
That's like work.
Jan Hatzius at Goldman coming up next. Looking forward to that conversation. The Goldman Sachs chief economist just around the corner on TV and radio with your equity market positive 0.35% on the S&P 500. Yields just a little bit higher, up 3 basis points. Your 10-year 341.77 from New York. This is Bloomberg. Bramo's theory for a hot real estate market in New York City. Honestly, I wish we could share this on air. That is amazing. Would you like to share that now?
I'm actually not alone in this. It's household formation. People are sick of living with each other after a pandemic, and so they're moving out.
So they're like breaking up and
breaking
up.
We call that divorce. Thank you, Lisa.
Let's move on. We have a great guest. We don't need to go there.
TK, you're right. We've got to get the mics on at the commercial breaks.
No, I want to do like sports, big, little, and
Yeah.
you know, they could see me mixing
How
my
about those
tang.
markets?
Nice. Thanks for that, Lisa.
Anytime.
Okay. The equity market on the S&P 500. Welcome. Looks like this on the S&P, positive 0.3%, up by 0.16% on the Nasdaq. Just a little lift here going into the weekend. Looking at the bond market, 2-year, 10-year, 30-year, shaping up as follows. Claims breaking out. Inflation in the right direction for some, bringing yields down over the last couple of days. Your 2-year down to about 391 this morning. Yields higher by a basis point there. Up 3 on a 10-year. On a 30-year too, up a similar amount. The curve steepening just a little bit with the emphasis on a little bit. In the FX market, the euro, a break of 109 against the dollar a little bit earlier this morning. We do that again. 108.90 right now. Bramo, we're negative on that currency pair, 0.2%. A bit of euro weakness out there through the week.
Yeah, and actually we're seeing more broadly a bit of dollar strength, perhaps just because that trade got so crowded. What I'm looking at in terms of the movers are what's accounting for the gains so far year to date. It is almost entirely artificial intelligence mentions. I mean, essentially, that is the argument of Societe Generale, that basically, if you stripped out some of the gainers due to artificial intelligence, there would be a negative returns on the S&P 500. NVIDIA, up 96% year to date, just to give you a sense. Microsoft, up almost 30%. Google, or Alphabet, 32%. And basically their theory is this is entirely due to this excitement around ChatGPT and how much artificial intelligence is going to totally change the universe. I find this fascinating that without this, U.S. stocks would be down. I find this actually really compelling, given that this has been the one hot trend of the year amid a complete dearth of anything else.
We've heard a couple of analysts say that Google is just doing the better job of PR around AI relative to some of the other players, or rather Microsoft is doing a better job relative to Google, who hasn't done a good job at all. Don't you find that just ridiculous that it's about who's doing a better PR job right now?
It shows that people are going to trade on hope. Americans going to keep doing what they do. I mean, honestly, this is part of the enthusiasm of creating something new. And Google, actually, to their credit, recently realized that perhaps they weren't doing a good enough advertising job. And so they came out and they started to do a better advertising job and saying that we have really good kinds of tools that we can implement.
I have the same skepticism, but my brother's a fancy pants computer guy, and he says ChatGPT is gone. He says changes the game.
Best performance stock on the S&P this year.
Changes the game.
Meta up by 96% yesterday. After that, NVIDIA, as Lisa points out, up by 95.5%. We're going to do Fed speak, Tom. Governor Michelle Bowman saying the central bank will need to raise interest rates further and hold them higher for longer if inflation doesn't cool. Jan Hatzius and a team over at Goldman still calling for a pause at the next meeting and saying here's the latest from them. The CPI report is supportive of our call for a pause at the June FOMC meeting. The shelter step down, Tom, looks increasingly durable. Inflation breadth softens somewhat further, and the strength in used car prices is likely temporary.
And just in the last 48 hours, this has changed because of the misguess on housing in the United Kingdom. Completely different story, but it shows you how humility is in order here. What's the key point you have on a humility at the moment, Dr. Hatzius? You look at the things you've made right, the things you've made wrong into the first 5 months of 2023. What's the humility you're writing about this weekend on inflation?
I would say mostly things have evolved the way we thought, at least in the labor market. For me, the labor market's really key, and the rebalancing that we're seeing there, I think is very encouraging, with job openings coming down and the unemployment rate still staying very low. So it's a very benign form of rebalancing. In terms of the tactics of Fed policy, I would have thought a pause in March would have made sense, and we thought that was the likely outcome. But I think, now a lot of humility is in order as we go into the next few months. There's obviously a lot of event risk, but I would say we're reasonably well set up in terms of the disinflation process that's underway.
The power game that's out there that you have to battle every day is on the x-axis, and to me, the markets are in short term. They're looking for drama to Labor Day, drama to October. Does Goldman Sachs extend out the x-axis, the healing out of the pandemic? Is the things we're talking about for October 23 really the things we're going to be talking about in June of 2024?
Well, I think by June of 2024, I would have, our baseline has the rebalancing in the labor market completed at that point.
Mm-hmm.
And inflation, down from, right now we're 4.5. By next year, I think we'll be below 3%. So I do think we're going to be in a very different place.
Mm-hmm.
In terms of the funds rate, though, I would expect that we'll still be, close to here, or in fact, where we are right now. I mean, our baseline forecast is that the funds rate stays at 5 to 5.25 for the next year or so. Risks to that, certainly on the downside. I think it's much more likely that you go from 5 to 3 than that you go from 5 to 7.
Okay.
But I do think the market is overly aggressive in building in rate cuts.
Let's explore that a little bit further. This was a question I got from a Bloomberg subscriber just moments ago, as soon as they knew that you were appearing. They said if stocks rally big over the summer because of the Fed pause, the economy holds up, the debt limit issue is sorted, what does the Fed do in the fall? How would you think about that? Just a piece of scenario analysis. What would that mean for you?
Well, I mean, directionally, it would point to, a higher funds rate. And obviously, the market is below the current level in terms of forward pricing. So, holding would already be, would already have some impact in terms of an impulse. But you might need, additional hikes. That's certainly a possibility. I don't think it's, particularly likely. If we see ongoing adjustment, if we see adjustment in inflation and the labor market, then there's also going to be a little bit more tolerance for easier financial conditions and stronger growth. But there's a limit to it.
If forward pricing adjusts upwards towards the Federal Reserve, would you consider that a tightening of policy somewhat? Is that how you'd think about it?
It depends on what it's driven by. If it's driven by a stronger economy, then no. If it's driven by, Fed messaging that they're less willing to cut, relative to the market's expectation, then I would view it as a tightening.
People are waiting for something big to happen because they're impatient and they're looking for a trading opportunity. And I'm curious, what is the next shoe to drop? Is it housing prices crashing?
Well, housing, I think, we had declines in house prices in the second half of last year. We actually have seen some stabilization in 2023 so far. So I wouldn't really expect, barring another major shock, for example, the sort of thing that John was talking about, significant further upward pressure on the funds rate. I wouldn't really expect a sharp drop in house prices from here. There's still some, I think, erosion happening. Some of that is also because the official indices lag behind reality somewhat, but I wouldn't expect that to be a big shock.
Was the banking crisis basically resolved and now it's just sort of the slow bleed of the reality of higher yields, or is there something percolating there that you're keeping an eye on as also a potential catalyst, especially if what John said does come to pass, where people price out some of those rate cuts?
I mean, our view is that the banking turmoil is going to be a drag on growth. We've said about 40 basis points or so, half a percentage point or a little less.
How do you come up with that, Jan? Can I ask?
How
do you and the team come up with that 40, 50 basis points number?
Well, the primary approach was to basically look at past changes in lending conditions in the Fed's senior loan officer survey, making assumptions about where that goes, and then feeding that into our model, which also includes financial conditions, and then getting sort of the extra effect over and above what you'd normally expect in a tightening financial conditions environment. That's how we came up with it. I would say that so far what we've seen in these surveys has been less pronounced. There's been less of a tightening than we expected. And now the question is it just delayed, or are we just seeing a smaller impact? I think that's a little bit too early to tell, also because obviously some of these banking issues are not yet resolved. There's still pressure in the market. So the last chapter probably hasn't been written yet. But right now, we're still estimating that 40 basis point number.
What's more pernicious for this economy? For it to be a slow burn, a slow tick, tick, tick of reduced lending, of tightening credit standards, or a sudden shock?
Well, a sudden shock is more pernicious because a slow burn, there are a lot of other factors in the economy that can offset the slow burn. Policy can react to it. Mm-hmm. So, clearly something that happens very suddenly in large size is much more difficult to manage if you're an economic policymaker. So I'll go with a quick shock here.
Long ago and far away, there was a guy named O'Neill and Dudley. They were at Goldman Sachs with Ed McKelvey, and there's this young whippersnapper out of Wisconsin-Madison in Germany who made his name on mortgage equity withdrawal. John Ferro brought up in the last hour the new housing dilemma. We have an America of 2.6% mortgages locked in, and they're never, ever going to sell. What does your team say about the housing economy of America? This is where you got your fame, Jan. What does your team say now about all those people out there locked into mortgages of their dreams?
So first of all, I would say, the housing bubble was really central in the pre-08 economy. Obviously, it hasn't been central in the recent economy. It's been important. There has been a big boom and somewhat of a bust. And mortgage equity withdrawal did pick up in 2021 to levels that were appreciable, I would say. Not dramatic, but appreciable. And mortgage equity withdrawal coming down since the peak of that cycle has been a drag on growth. I'd say specifically on the lock-in from 7% 30-year mortgage rates versus maybe 3% or 4% that people took out the mortgage rates at. I do think that is part of the sort of slow burn that Lisa talked about. I mean, I do think it probably at the margin reduces mobility somewhat. The research on those issues has been somewhat mixed, so that's why I'm putting this in somewhat cautious terms. But I do think it probably is at the margin more negative for mobility, until more time has passed.
Are you avoiding debt ceiling conversations at the moment with clients? Do they want to talk about it?
I talk about what clients want to talk about, of course.
Is that top of mind?
That's the Solomon method of economics.
Is it top of mind? Yeah.
It's top of mind for a lot of people, and undoubtedly over the next few weeks until whatever the X date is, it will remain top of mind. It probably will go right up to the wire, just looking at the political dynamics. And it's still, unclear how exactly it's going to be resolved. Our baseline is that, there's going to be a resolution very close to the X date, and that, ultimately you do get some spending cuts or some spending caps, but we don't expect anything as large as what we had in the 2011 situation.
We'll have to see what that means for the outlook as well. Jan Hartjes at Goldman. Jan, thank you. Just getting some headlines on the debt ceiling. Senate Majority Leader Chuck Schumer says Republicans must take default off the table. We've heard these messages before. Staff to continue meeting on debt limit negotiations. Of course, we heard a little bit earlier, overnight, that there's going to be a delay to the meeting between the President and the Speaker of the House. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says the only satisfactory solution is for Congress to raise the debt ceiling. Yellen spoke to Bloomberg in an exclusive interview.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that gets done.
Yellen is in Nagata, Japan for a meeting of G7 finance ministers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Actual default. That is potentially catastrophic. And you can go through a million ways, but anyone knows that's potentially catastrophic. And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic. Markets get volatile, maybe the stock market go down, the Treasury markets will have their own problems.
That was Jamie Dimon, JP Morgan Chase chairman and CEO, on the potential for a default. But ultimately, this gets addressed. It gets addressed. Why? Because the market will start pricing in the potential for a default. That's how it works, Bramo. Get a bit of tension, some pain, and all of a sudden politicians get their act together.
I hate this. You know that I do.
Oh, everybody
I feel
does.
visceral
Find someone
about
that loves it.
I mean, well, I don't know. Then if nobody loves it, why are we doing this? Why can't we have a more constructive discussion? Again, I'm not saying there isn't a reasonable discussion to be had about where people spend the money, where the nation spends its money and its budget. But to hold the U.S. basically hostage as a result of this in this sort of political shenanigans with talks having one tenor and then the public message having another is frustrating.
Political point scoring. Just a default position. You believe that you can get more support by fighting the people on the other side. Tom, I think actually over this matter, no one wins. I think everyone looks ridiculous
Everyone
not
looks
solving
ridiculous.
this issue.
Totally agree.
Could not agree more.
Totally agree. Just can't say enough about it. What are we going to do about Twitter? I mean, where's Twitter like...
Getting a new CEO, I hear.
No, I know, but where are they going to be in 6 months? Where are they going to be in 6 years? I have no clue.
Well, hopefully we'll hear from the new CEO and they'll share that.
But have we nailed down a new CEO? I'm not sure we have. I mean, it's just like...
There are rumors.
Rumors. It's speculation.
It's more than speculation.
Well, didn't Elon Musk say that he'd hired someone and then the rumours are the talks? I don't want to say I hate the word rumours. The reports are that it's someone from NBC, correct?
That it's the head of advertising, which would be a really interesting move. And it's actually a pretty big get, potentially, at a time where he's looking for legitimacy after a lot of people have really questioned his leadership.
If we've given you enough confusion there to provide clear talk, Bloomberg Quick Takes Alec Webb joins us from London on the Twitter Derby as well. Give us some clarity here, Alec. I look at where we are with Twitter, and I think everyone in their own way is exhausted by the last year of Twitter. What's a new CEO going to do if there is a new CEO?
Yeah, as you say, it's been reported by the Wall Street Journal and Puck that Linda Yaccarino, who is the head of advertising at NBC Universal, is in talks to take over as CEO. Elon Musk would stay on as chief technology officer. It sort of seems as though essentially she's the person who sits down with the advertisers and says, come and advertise on our platform. Presumably may do some building of the actual advertising product, but ultimately Elon Musk is still going to be running the lion's share of the company. We've seen there's been a mass exodus of advertisers since he took the reins, concerns about content. He himself has been in the room with advertisers, been reporting from Bloomberg that didn't always have a brilliant effect in some of those meetings. So it's certainly an interesting possibility if she does indeed get the job.
John, I don't know about your feed. In my feed, it went from better ads to garbage ads, and now there's almost no ads. I don't know if it's me or what.
I tend not to pay attention to the ads in my feed. I
never have. No ads.
That For You column, though, I just get a lot of people fighting. Just seems to be fights.
I get animal videos.
You get animal videos?
I don't know what that says about us.
What does that say about me? Just people fighting.
And I get little puppies and cute little, people hugging and things like that.
They've got you wrong, haven't they?
Oh, hey,
they
watch it there.
Have the fights.
Oh, yeah,
and stuff
that's
like
right.
That. That's very Bramo-esque. Alex, are you suggesting that Linda Yaccarino is going to come on board and be the head of ad sales with a glorified title?
It sort of looks a little bit that way. You don't forget that clearly Twitter is a massively influential company, but the business she runs at the moment generates in excess of $10 billion a year. Twitter, pre-Elon, had revenue of about $5.5 billion a year. She's running a far bigger advertising operation at the moment. And actually, NBC Universal's ads product isn't just for NBC Universal platforms. If you're in Apple News and you see an ad on there, it is served to you by NBCU. So actually, that's a kind of competitor to Twitter. There are some things that Twitter can do in terms of improving its ad product. You complain about, inverted commas, the quality of your ads. That's really something advertisers think about rather than consumers. But it doesn't have great advertising targeting because it doesn't know as much about you. It doesn't know as much as Meta does, as Facebook does. So if there's going to be a piece of that she's coming in improving the data quality, it's maybe concerning for users, it's better when you come to thinking about the revenue per user, the amount of ads you can serve them, and the targeting of those ads.
Alex, are you getting a sense of what the vision is for Twitter? I mean, Tucker Carlson basically getting a show, announcing he's going to have a live show on Twitter that's going to be live streamed at a time when that was actually controversial for the Fox era with respect to advertising based on some of the things that he said. And then you have this stalwart advertising head at NBC Universal coming in. Is there something going on that gives you a sense of what the future of Twitter could look like?
I mean, baby steps, perhaps. Let's assume that Elon Musk himself has a very clear vision of what Twitter is going to look like. That is not immediately clear. We talk a lot. There's a lot of talk about the X app, this sort of super app, which will be an equivalent somehow to what WeChat does in Asia. We're a very long way from what WeChat is able to do. If you're going to get to a super app kind of product, you need to have loads of developers building their own apps for your platform. It's a gateway to a bunch of other apps. Now, if you're a developer and you're faced with the choice of building something for Android, for Apple's iOS, or maybe for whatever Facebook's coming up with in the metaverse, these are products that have potentially hundreds of millions, if not billions of users. Going for the 200, 180 million perhaps users on Twitter, less appealing.
Alex, you're expert at the digital ad dynamics. The dynamics of the last 90 days is a general statement are just outright bloody. There's no other way to put it. Do you suggest a longer timeline to digital advertising challenges, or is it of a shorter duration?
I mean, look, there are a lot of short-term challenges right now. They have come straight off the back of huge changes in the digital advertising ecosystem. I hate that word, but, you know, the digital advertising market in terms of cracking down on privacy. It is in a little bit of flux. That is why Facebook has been trying to get into the metaverse, because it can control that space. I think that ultimately right now, it is the worst point because of the, you know, macroeconomic conditions. There are things that can be improved going forward, so it's not as though this is an idea that we're going to be around for a very, very long time.
Alex, thank you, buddy, for the update. Alex Webb there of Bloomberg on the latest from Twitter. I would make 2 points. One, the current leader of Twitter has been pushing a subscription-based model and is now reportedly hiring someone who runs ad sales at NBC Universal. I think that's potentially quite interesting. There's a clear shift there. Mm-hmm. Two, the challenge of creating a platform or developing a platform and producing content, if they go down that route, I've got no idea if they will, in a world where people just desire echo chambers, particularly here in the United States. And I would bring up the outrage over having the former president of the United States on CNN, and the amount of outrage there is off the back of that, to have the former president, who more than 70 million people voted for in the last election, go on a major network in the United States. And, of course, there are bound to be lies and falsehoods, if you want to choose that word. That's to be expected. But ultimately, that's a former president with more than 70 million people in this country voting for him. And the amount of people who are outraged with CNN for taking him on air is just amazing to me.
The larger point here is really well taken, and that's what my mind was going. If you're going to create content and you're going to focus on advertising, how do you cater to the inevitable angering that you are going to create of the advertising base? Think about Bud Light and what happened there.
Totally.
I mean, think about what happens when you have a Tucker Carlson or take your pick on the other side of the political spectrum, making statements that get people annoyed. How much do you get involved and really become a pseudo information network akin to a broad cable network?
Yeah. I thought the Atlantic magazine had a nice distinction here in the last 24 hours of uproar about this, and they said it wasn't that the former president was with anyone at CNN. It was the format of a town hall meeting, clearly with an audience pre-selected for him.
Are we saying it's outrageous there were people there that had voted for the president?
Well,
that was outrageous.
They should have done what the Atlantic was suggesting, is do the same thing, but just have it be him and the reporter to get more information out of it. I don't have any opinion on it. I could care less, to be honest. But what I do think, there's an elephant in the room in all this, John, that was really underreported as we talked to Alex Webb there. Time magazine dropped their subscription program this month. And to me, this is Mark Benioff and our good friend Keith Grossman. Full disclosure, folks, a good personal friend. Keith's moved on to crypto things. But that Time magazine dropped their subscription model is the news unreported in the digital space in the last 30 days.
And that was the first point I made, Tom. I wonder what this means for Twitter Blue. It's hardly a ringing endorsement of a major product push from Elon Musk and Twitter.
I'm going to listen to Brian Weiser and other experts on this. I got a fountain pen and I dip it in the ink.
Nice. Old school.
Old school.
That's the way it should be, TK. Old school.
Quill.
Cameron Dawson and New Edge coming up shortly. Your equity market positive 0.3% on the S&P 500. Live from New York City this morning. Good morning to you all. This is Bloomberg.
What has prevented monetary policy from biting on the economy was all of the fiscal injections.
Real incomes are going to expand this year. So if that is what's happening to the underlying pocket, then why should they not spend that?
Mission is not accomplished on inflation, but that's a good reason to pause.
We are at or very close to the tightening cycle for a lot of the major central banks.
Investors are pricing in rate cuts, and that's not something that we see. The Fed is not there. They don't have the ability to do that with inflation where it is.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. On a Friday, it's Reset Friday here on radio and television, staggering into the end of May. Debt crisis out there. Comments from James Dimon. Comments from Janet Yellen. It's been a busy week, John.
Only the middle of May. Trying to stack it towards the end of it already, Tom. Not even 2 weeks into this mess.
It feels like we're 4 weeks into May. I mean, particularly when you look at the volatility of the two-year yield as the metric here. It's up and down and up and down.
Start of the month. Brammer was trying to wrap up the year.
Yes.
Wasn't she?
We're like 10 months into May. I mean, that's what it feels like.
It's exhausting, and I'll be honest, I heard that from Jamie Dimon yesterday. It's just, everything is a battle every day, including the banking crisis we've touched on today.
There's always something to worry about, whether it's the banking crisis and the debt ceiling debate. We've seen this one coming a mile away, haven't we? Just been there on the horizon. We're like, ignore it, ignore it. Then Yellen comes out June 1. X-date maybe. You're like, ignore it, ignore it. The talks start, and you're like, please stop, stop. Yeah. Tom, we're in the foothills of it. It's just starting. It's just starting.
PacWest 4.70 just opened ugly in this 8 o'clock Wall Street time hour. 4.57 is where we were moments ago. I mean, it's still there, whether it's the debt ceiling or it's the banking crisis. I think that's the lead message on
So let's pick
Friday.
up on that name, Tom. So PacWest got hammered in yesterday's session off the back of their own indication that deposits started to roll over, off the back of stories out there, including ours here at Bloomberg, that they were in talks potentially with other companies, investors. They confirmed those talks. Deposits dropped by 9.5% on the week. Just seems that we've gone from one thing to the next, but really still haven't moved away from that issue around these banks. You start to see the stock break, 460. I said a couple of Mondays ago this was a double-digit name. It's still at 460 right now in the pre-market, Tom, and that makes people nervous.
And a lot of people calling for the end of the crisis. I did not hear that from Mr. Dimon yesterday with Francine Lacroix, but there's a lot of people, generally in the zeitgeist saying, well, that was harsh, it's over. Baloney, it's not over. I see no evidence whatsoever. It's over. I mean, Lisa, I'm sorry it folds into the confidence of the nation, including the debt ceiling debate.
There is a lack of confidence one way or another. And Jan Hatzius was talking about that sort of slow burn. And this is my question around the moment, which is, if we're in a slow burn, how does this market deal with it? It is used to big catalyst events. It is used to following the Fed, doing whatever the Fed's bidding is over 10, 20 years. All of a sudden now, we have a muddle. We have uncertainty. We have economic data. We have specific corporate earnings. We've got corporate stories. This is an unusual market for someone who has grown up under the auspices of monetary policy and only that and big catalytic events.
I love a Bramo rant. Sometimes they just feel so rehearsed.
They're just
I know they're not. I know there's no script, just to confirm, but they feel that way sometimes. Let's whip through the price action for you just briefly, going into the opening bout. 1 hour and 27 minutes away. I missed this. This is why I'm back just for one day before the weekend.
That's so sweet.
Yields up by 3 basis points.
BS,
not how
but cool.
people describe me. BS, maybe close to the truth. 341.77 on a 10-year, Tom, in the FX market. 108 on a euro against the dollar, 108.93.
I look at the two-year yield, 3.92%, John. I mean, where's the critical level there? I think we've got to go lower, maybe 3.85, 3.84. We're really not there.
The euro side of this is the one to watch for me. I find it really interesting. We've got people lining up to say the ECB is going to go further, that the economy is robust, the epicenter of the risk is all right here. It's in America. Banks, debt ceiling. And then you start to see some data come out of Europe. It's factory orders, and you're thinking, oh, interesting. Then Mess comes out and says a couple of things about global trade. OK, let's keep an eye on that. If you get more of that euro story can break down quickly. That's one to watch.
Yeah. Very interesting to say the least. What we know is if you go back to the Orlando Sentinel from a few years ago, you can talk about a sterling ballerina and a ballerina career that was legit. And what the parents said to Cameron Dawson is, have a fallback. Her fallback has been sterling strategy for Bank of America, among others. She's at New Edge Wealth right now, their chief investment officer. Tell me about the ballet we're in right now. Ballet, that's a tough business. Your body falls apart. Is our economy, is our financial system falling apart right now?
Well, the interesting thing about ballets is that they always either end in a wedding or a death. And so I think that's what we're looking at with this cycle, which is that are we going to have a recession or not? And that's why this market has been flat, because we're in this world where we know the risk of recession is high, but we're not seeing the whites of the eyes of it in hard data. And that's why we continue to have this sideways chop.
Do you operate with the assumption that we will get one this year?
This year, I think, is the operative word. It could lean more into 2024. I think the interesting thing is just at the precise moment when economists and the bond market are expecting a recession to hit, those cuts to hit, is when the equity market has earnings starting to reaccelerate and rebound. And that's a really big schism for this market.
Have you got this tradable window then? What do you do with it between the last Fed hike, if indeed it was the meeting before, and the recession that you start to see in some of the data, payrolls, etc.? What do you do in that window?
You probably trade on technicals, things like momentum, and you trade on positioning and sentiment. Those kinds of things can drive the market in the short term, and it's really in the medium term where the fundamentals start to matter. So when we look at that 4,200 level, there is this risk that we move higher. And I say risk because people aren't positioned for it. That is the pain trade, that we don't get above 42, and it may not be justified by the fundamentals in the medium term, but the technicals, the sentiment, positioning could get us above that and really make it a very big pain trade.
What happens, though, if we don't get a catalytic event? If it's just sort of, little data points that you can justify with the narrative that you desire, and this is what we've been getting for a lot of this year, and we're going to continue getting for a number of months based on what a lot of people are saying. Do markets just stay in this range?
It reminds you of 2006, 2007, because the writing was on the wall that things were certainly starting to weaken, yet markets shrugged them off because you didn't see the whites of the eyes of the weakness. The Fed had paused, and it wasn't until 2008 that we started to see unemployment tick up and really the Fed start to react to that. So there's a long precedent for these cycles simply taking a long time. It's like watching paint dry, which is why we have to think of this in two time frames, the short term being driven by those momentum indicators and medium term by the actual fundamentals.
The boiling of the frog until suddenly there is no frog that is alive and hopping. There's a question about, this is not 2008, and people are talking about that based on the global banks that have plenty of capital. But is this leading to some sort of fissure, some sort of seizure that is going to lead to massive valuation drops, or is it not? Or is it going to be something that's more akin to the recessions of yore?
Well, I think it starts from your point, Jonathan, all the time about how we shouldn't always just index to 2008. Because just indexing to the extreme is not helpful. The reality here is that we're likely going to see some slowing in loan growth, and that typically coincides with slowing in economic activity. It should be expected that banks, small banks who have been annualizing loan growth at 8% for the last cycle, will see that slow in response to that. That will have real economic impact, and at this point, it's not being priced in.
I'm with you. I agree with you, obviously, because you agree with me, and you can come back any time to talk about it. People will want to benchmark to something, though. What should you benchmark to? What is the parallel right now for you?
I think it's somewhere in between the 2018 experience where we didn't have a recession and the Fed was able to ease and there was no inflation, and that extreme of 2008. Remember 2016, we got very, very close to a recession. We flew very close to the sun, and we were able to avoid it in that scenario. I think that's probably a good parallel for us to say, where could the earnings risk be? We think that we have some recession. It just won't be as deep as 08.
One of the great realities of Florida right now, your Florida, is everybody's been there for 3 cups of coffee and think they're experts. You own the high ground on Florida. Is the economy boom there legit? And it is a symbol of an optimism in America that we underestimate.
I've always considered Florida beta on the economy because there is so much discretionary spending in Florida, and it tends to have more pronounced boom-bust cycles than most other states. And always when you're in a boom, there's always this notion that this time is different. It's never going to end. But I'm hearing people leave places like Miami because they're getting priced out. They can't afford it. That may be the first indicators that some of this high beta flying parts of the economy are finally starting to feel the pinch of price pressures.
I mean, I mentioned the ballet at the beginning, and I look at the damage out there, and my whole thing is corporations will adapt and adjust given cards dealt. That's what I see right now for a part of the Standard & Poor's 500, not all. How's that trend going to play out this year?
Well, certainly that's what we saw in the first quarter. That's how earnings came in better than expected. We saw corporations adapt and adjust and defend on the margin line. The thing that will be interesting to watch is that if inflation really does roll over and it falls, that means revenue growth is going to fall.
Nominal GDP comes in, revenue comes in.
And that usually leads to margin pressure, regardless of what you do on the cost side, because you lose the incremental margin dynamic.
John, Honeywell with a banner across the Bloomberg years ago, all of a sudden they were doing an 8% organic revenue growth. No one had ever framed that. And when they come back to 6%, not to pick on Honeywell, that's going to be the game changer.
This was great. Cameron, thank you. Cameron Dawson of New Edge Wealth. I should have done ballet. My posture's awful. Is that where your posture comes from?
Well, it's
Very
all in the
upright.
core. Any discipline, whether it's martial arts or if it's ballet, is all from the core.
Martial arts or ballet, one or the other.
How's
your core doing,
it all hinges off
I
of that.
saw
So that's where posture
Suzanne Farrell and Peter
Proper
Martins
morning
at their
television radio,
absolute
this
peak,
is.
and I still
Horrible.
carry it with me, how spectacular it was.
Magical.
Magical.
This was magical, TK.
That's my ballet talk there. That's my entire ballet talk. You just heard it.
Up next, Ed
How's my
Mills
core look,
of Raymond James. Oh, it's perfect. Super tight. Super
Good,
tight
have
on
some
night,
tang.
TK. Ed Mills of Raymond James on the debt scene in that conversation coming up shortly. Here's a snapshot of the price action for you on the S&P 500. Equity futures positive 0.3%, up just a little bit. Yields a bit higher as well by 3 basis points. 341.59. We're light on data today, aren't we, Bramo? What have we got? Nothing?
Nothing. Oh, no, we've got University of Michigan survey. Well, how can we forget?
My favourite.
It's going to be amazing, especially given the inflation read going
I
out.
so won't be running out the building at 9:56 and 30 seconds. I'll wait for that. I'll wait for that.
Yeah, you're full of honest statements today.
My favourite data point.
What else do you have
Love
dripping
it.
with sarcasm?
So much more.
I think it's interesting. I'm going to be watching it.
Good. You can tell me all about it on Monday. Your equity market on the S&P up by 0.3% from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit that was set for today. The delay signals that progress had been made in talks between staffers aimed at averting a catastrophic U.S. default. McCarthy says the president will meet with him and other congressional leaders next week. House Republicans have passed a symbolic border security package. The legislation would ensure fewer people could claim asylum in the U.S. and lock more migrants in detention facilities. It has no chance of passing the Democratic-controlled Senate. The bill's passage came on the same day that pandemic-era border restrictions ended, ensuring an increase in migrant arrivals. Twitter appears to be getting a new chief executive. There are multiple reports that Elon Musk is in talks to hire the head of global advertising and partnerships at NBC Universal to be the social media platform's next CEO. Linda Yaccarino joined the company in 2011 after nearly 2 decades at Turner Broadcasting. Musk has said he'll become Twitter's chief technologist. UK tech tycoon Mike Lynch has been extradited to the U.S. He faces a criminal fraud trial for the sale of his autonomy corporation to Hewlett-Packard Enterprise. Now, Lynch is accused of dressing up the software company to induce HP to buy it for $11 billion. A year later, HP wrote down the value of the deal by $8.8 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that gets done.
Janet Yellen sitting down with the brilliant AMH over in Japan at the G7, the Treasury Secretary, leaving the spotlight on Congress to get something done. There was meant to be a meeting today between the President of the United States and the Speaker of the House, Mr. McCarthy. That's been postponed. We're told that there's nothing to worry about, to see here, because staff-level talks are ongoing and will continue into next week. TK, I guess we'll see.
In our last block, we talked about mid-May, late May, and that. I'm sorry, this is a late May story. If first week of June is when the panic sets in. I mean, that's to Cameron in our last block, that's the ballet we're in right now. We have to wait and see to get the calendar date set.
Fair to say this equity market does not capture panic in any way, shape or form on the S&P 500. Still in and around 4150. Equity futures positive here, Tom, by 0.3% going into the weekend.
And you have to see on that. Again, I'm looking at a VIX under 17, and it's basically a miracle given all the angst that's out there on a May Friday. Right now, we're going to speak to an expert on angst in Washington. Edward Mills is Washington policy analyst at Raymond James, steeped in the cynicism of the white marble of Capitol Hill. Ed, thank you so much for joining. We're focused on the Secretary of Treasury in Japan. I want to digress from that to the imagery all of us have seen, listeners and viewers, of the Mexican border and the shift from COVID immigration policy to after COVID immigration policy. Just as a digression into the weekend, does anybody in Washington care about the stunning images we are observing?
So, Tom, absolutely, they care. The question I always ask is this going to change anything from a legislative perspective? We could see some sort of Title 42 kind of specific piece of legislation. However, I don't think the politics are there for comprehensive immigration reform. Anytime we do have a crisis, we see an uptick in conversation. But right now, the politics, as I mentioned, especially in Republican primaries, don't tend towards a comprehensive solution, which is really the economic impact, because a lot of the conversation is kind of what does that do for labor force participation? What does that do for some of the JOLTS job data where we see a lot of open jobs? Comprehensive immigration reform is usually part of that conversation.
We're looking for comprehensive debt ceiling reform as well. What does the Ed Mills calendar look like to the end of May? Does anything get done to May 31st, or is that just not going to happen?
So I'm not sure May 31st really is the date, Tom. I do think that near term, what we're going to be focused on is what happens before President Biden gets on Air Force One, goes over to Asia on Wednesday. There might be a little bit of a freak out if there's not a deal to be had then. But I really dug into the numbers of the Bipartisan Policy Center's X date. And what that tells me is that, June 1st is an important deadline, but somewhat of a soft deadline. And that's what I hear people in DC telling me. If we can get to June 15th, which is the next quarterly payments of, kind of the IRS, we might be able to get to June 30th. And if we get to June 30th, there's $145 billion of government retirement funds that get freed up, which could get us well into July. So DC's kind of on this two-track process, trying to create a crisis to see if something can get done now, but recognizing that there might be more leeway on the back end. And so this might be a little bit of a pull forward of negotiations because people aren't quite sure June 1st really is the date in D.C.
All that I'm hearing, Ed, is that basically we're going to be talking about this for 3 months at least as people try to ramp up some attention and not really hit that X mark. We were talking earlier about what the prioritization of payments will be should we get there. Janet Yellen was saying she doesn't even want to talk about these hypotheticals. I'm sure that they are talking about it. What are the chances that the U.S. would pay Social Security checks over the full faith and credit U.S. Treasuries?
So, Lisa, that's a really good question. And I think that if we're in that scenario, two things will happen. One, we will have a market correction that is going to be a forcing mechanism on D.C. In the past, that's been part of the reason how they've been able to get this done. Number two, I don't necessarily know if the Biden administration would send out the Social Security checks over paying the interest on the debt, because that could be a huge leverage for them. If we're in a world where certain seniors are not getting the payments from Social Security that they have been promised, that's a political crisis that could resolve this quickly. And I do think from the Biden perspective, that's part of where he thinks he has a strong hand, trying to make sure that this is as clean as possible. But McCarthy can't give him that deal. That's why we have a problem right now.
Ed, this is an incredibly frustrating conversation, in part because I know that there are policy workers, staff members who are working on the nitty-gritty in a very practical, sort of technocratic way. And then the discussion is, what can we give to our policymakers? What can we give to the politicians to go out there to say it's a win and the other guy is terrible? And how much is that really the sort of duality of what's going on in Washington right now?
Lisa, that's how Washington works. I think that the good thing about this debate so far, and I agree with you, this is one of the most frustrating parts of my job, one of the things that I least like to talk about because it's so unproductive generally, and just really kind of gets people sour on Washington, D.C. But with any negotiation, when you're really stuck between cut spending, raise taxes, you have to expand the pie. And so part of that expansion, Lisa, is there an opportunity to expand economic growth? Is there an ability to do energy permitting reform? We have the Inflation Reduction Act. That's step one. Unless you get energy permitting reform, a lot of that clean energy in legacy energy and the transmission of that in our infrastructure doesn't really work. You need to do that. And so maybe instead of cutting spending or having a percentage cap, maybe we can focus on what is the deficit reduction over the next 5 to 10 years. That's a political thing that Democrats can come to agreement with. Biden likes to talk about how much the deficit has been down under his presidency, still much higher than I think anyone would want to see. But that's an easier part of the conversation rather than committing to an X percentage cut or X percentage growth that comes with even harder choices down the road. It's a political off-ramp that each side is looking for to avoid default. And because they're not looking for default, that's where I still believe there will be a solution.
Ed, you've got to help me keep Bramo on the rails. Lisa's losing it. We've got a few more weeks of this to go.
I can't take it.
Ed Mills of Raymond James. Ed, thank you, sir. Thank you. You are not happy about this, are you?
You know, it's just frustrating because there are very real issues that should be discussed.
Of course.
I hate that they get overlaid with all of this posturing that tries to cater and dumb down the conversation in the public. And that upsets me because we have a lot of very real issues and a lot of very real people who have to deal with it. And it's for both sides. Why can't there be an honest discussion of the details and trust that people are going to pay enough attention?
TK?
I'm going to go, John, back to yesterday. I know you're going to wander off here, and on a Friday, I want to wrap up with what I thought was the stunning quote of the week. No, are you? Yeah, where you're going to wander off, right?
I was going to stay, Tom, but I'll leave.
Okay, well, you can do either
I'm joking.
one.
I was going. But got the promo ready. I was going.
John, what we heard from Hugh Pill yesterday of the Bank of England was absolutely stunning. John Riding was eloquent about it being a throwback to Keynesian United Kingdom. The built-in austerity of dialogue in the United Kingdom is, to me, it's just enduring. It doesn't go away. He wants people to spend less money. He's begging people to spend less money in the United Kingdom.
To stop asking for pay rises as well.
It's a joke, but it's not. It's completely un-American.
You said something earlier this morning that stuck with me, and I think you're right. Everyone right now has their own problems.
Yeah.
The UK, the US, France, take your pick.
Yeah.
Many of them.
It's the time we live in.
Here's the promo ready for you in the next hour on Bloomberg TV. Luke Hickmore of Aberdeen, Subhadra Japa of SocGen, Chris Harvey of Wells Fargo. That conversation coming up in the next hour on Bloomberg TV, taking you into the opening bell with equity futures up by 0.3%. From New York, this is Bloomberg.
Good morning, everyone. Bloomberg Surveillance on a Friday morning. We recalibrate into the weekend. Your reading over the weekend is simple. This American economy forward. Lisa Abramowicz and Tom Keene, John Ferro getting to the next hour. Chris Harvey will join John Ferro. Really interested to see what Chris Harvey says about the repricing of equities. 41.54. I'm going to round that up to 4,200 because I can do that. Futures up 10. And the VIX under 17. Wow, could you imagine the VIX a 15 print? No one's framing that.
Some people are saying that it doesn't accurately reflect some of the actual volatility, and so people are talking about that. But I will argue that you see bond volatility coming down as well.
Coming down a little bit. The two-year yield, don't tell me that in the last 24 hours, 3.92% in the two-year yield as well. We're going to get you prepared for the weekend with the careful thoughts of Kathleen Bostjancic. She's chief economist at Nationwide. She has a wonderful holistic view of the American economy. We're going to go there right now. Kathy, you say just simple, follow the bond market. Explain this to our audience that's in Bostjancic 101. Why follow the bond market instead of the stock market to try to make a judgment about which stock to buy next?
Good morning, Tom and Lisa. So I say follow the bond market in terms of the outlook for the overall macro economy. The bond market is much more sensitive to incoming economic data than the equity market. It certainly matters for the equity market, but earnings are key for the equity market. And the bond market tends to sniff these things out more quickly than the equity market. I would say there's almost this sort of embedded optimism in equities relative to fixed income or the bond world, and it's more than just the inverted yield curve. It's just looking at the risk overall, like looking where 10-year yields are trading relative to where we're going, and what are the inflation expectations and growth expectations embedded in there.
Friday noise out, import prices, export prices. John Riding, when he was at Bear Stearns, said, Tom, you got to follow import prices. They matter. They're giving me a little whiff of disinflation here. I mean, I don't want to oversell it, but maybe that's secondary data coming out moments ago. And there's a little David Rosenberg saying he sees the inflation cycle broken. He published that 20 minutes ago. So, that's sort of the mood here.
There seems to be consensus that inflation is trending lower. It might not be in a straight line, but there is not consensus about how quickly it's going to trend lower and whether or not it's becoming entrenched in the psyches of the American people and, frankly, globally. Kathy, how much are you viewing that as a big concern, that there's almost an acceptance that prices are going to go up at a much faster pace than has historically been the case for the past few decades?
Well, that's really the risk, Lisa. That's what the Fed frets about most, is that it gets embedded into inflation, what they call inflation expectations, and businesses and most importantly, consumers start to act as if, well, this is the new norm, where we're not going back to a world that we struggled to get 2% inflation. Now we're looking at something, if we get to 3%, we're lucky. So that's the risk. We haven't seen that yet in the statistics. We'll get the University of Michigan data, consumer sentiment data later this morning, and we'll see what the inflation expectations are as consumers weigh in. So we haven't seen that. That's the good news. And we are seeing some elements of disinflation. Problem is, it's not happening very quickly. And then that increases the risk that eventually, just as you say, people start to accept this and it becomes the norm.
Kathy, I want to get your view on what Cameron Dawson was talking about, that this reminds her of 2006 and 2007, with this sort of calm, this relative ease with the backdrop of a Fed that has raised rates quite significantly and somewhat slowing economic growth. Do you think that that's true, that this is basically building up to something that people have basically shrugged off and gotten complacent about?
Yeah, it's a very different backdrop, of course. But yes, similar in the sense that, again, the bond market's been flashing these recession warnings for a while. And I know everybody's getting tired of, talking about it and saying it's kind of like waiting for Godot. Where's this recession? But that's what happens, and then eventually it hits earnings. And then the realization in the equity market that, we are headed for a downturn, and it's going to be rather hard, not necessarily a deep, protracted downturn, but it's not going to be a soft landing. And there's just these delays. I mean, it could be anywhere from, a few months to almost as long as 3 years before the inversion of the yield curve and the economy turns down into a recession.
Kathy Bostjancic, Nationwide has such a 50-state view, and of course all the heritage of Ohio and the Midwest as well. How are we colored being within 3 zip codes in New York or 2 zip codes in LA or maybe 3 zip codes in Miami and Washington? Just the whole city-centric view versus what you see coast to coast.
Yeah, it's a great question. Well, I think that right now, across the country, you are seeing some similar characteristics. There is a really tight labor market, and there's concern, right? Whether you talk about farmers in the Midwest, or you talk to manufacturers in the Midwest or on the East Coast, there's this concern of uncertainty, and that's really the biggest issue, right? And that the understanding is when the Fed raises rates, things tend to slow down in the economy, or maybe things break, as we saw in the banking system. So I think there is this concern, just broad-based, no matter who you talk to. Like I said, the farmers are also asking, what's the outlook? And we're concerned, and we're seeing some things, and it's many issues, right? It's the labor force, particularly. They keep coming back to when is that going to change, and when are we going to see maybe some reprieve on the wage front? That's a big issue.
And this is important. Dennis Gartman chastises me because I don't look at commodities enough, and I'm talking, folks, about the softs across the Midwest. I mean, it's not copper, Kathy, but what do the farmers of America say here when I see corn moving from $8 a bushel down to $6.32? I mean, even within agricultural America, there is this disinflation going on, isn't there?
There is, and there's, you hope that as we get disinflation, and if they lose some pricing power, because that's part of it, right? And that's eventually, I think, it's going to feed back to the equity market and earnings. You hope that the wage pressures, and that's what they're really facing now. It's not the input, it's not even the commodity prices. Right. It's really the wage pressures and the lack of workers. There's also a call for, what are we doing on an immigration? We could use the workers and some, help there.
And Lisa, what's important here, and it's embedded into what Kathy just said in wages and in petroleum, within agriculture, yes, there's disinflation in corn. I know you're nailed to the cornflakes price at whole paycheck, but the answer is we're not back to where we were pre-pandemic. We got a long disinflation way to go to get food prices back to normal.
And people have accepted it. And this is something that I've noticed. Is
That's
that
interesting, yeah.
Profits at companies are actually expanding. And that was CPI coming in hotter than PPI. The input prices are actually disinflating faster than the prices that people are being charged in grocery stores and in just at the mall or wherever.
I mean, you were hysterical 3 or 4 weeks ago over how many tomatoes were in a tomato can. Are you counting cornflakes in a box of cornflakes? They're putting less in it.
Everything that you get, shrinkflation just absolutely drives me nuts. It's like if you're going to shrink, if you're going to give us less, you might as well just call it. But Kathy, given the fact that we are seeing all of this, are we seeing the pushback that you would expect? Or is it, basically this discussion that we're still working through the stimulus money and it's still sloshing around the system in a way that many people don't realize?
Yeah, I think it's the latter, Lisa. At the same time, I have been surprised by the resilience in the labor market and the consumer, but their estimates, San Francisco Fed came out earlier this week. There's just still $500 billion of excess savings that related to the pandemic that's still on consumers' balance sheet. And it's not just the upper income households will have that. So that's going to continue to fuel things. And remember, we still have the travel revenge, right, spending. That's going to take place throughout the summer. I think come the fall, though, let's assess things and let's see where the consumer is, how they feel. They certainly don't like higher prices. But if the labor market starts to continue to crack, they're going to have less ability and less willingness to accommodate, higher prices. And I think that really is the key at this point, is what happens with the labor market.
Kathy, just want to wrap up with this question around Fed speak, because we get a lot of it. And it used to move markets quite considerably. And it kind of doesn't as much anymore, because a lot of it is we just don't know. And each view is very much a view based on certain data that very well could change. Are you gleaning less and less from the rhetoric from the Federal Reserve?
Well, I still pay very close attention and try to read as many of the speeches and comments that are made. But I think your point is well taken, that the markets have really turned a deaf ear to them, and that's why we continue to have that disconnect between the Fed's forecast and what the bond market's forecasting, and the bond market's still looking for rate cuts, relatively soon in the second half of the year, where the Fed Reserve has a forecast, and the commentary is, if anything, it's hawkish. They're actually saying, we're not sure we're quite done tightening. Right. I mean, we do think they are. We think they can pause. But, the inflation numbers, they eased a little bit, but they're not coming down very sharply. And that's still uncomfortable for Fed officials.
Kathy, thank you. Kathy Benchancic with us this morning here. Just a very nice overview to get you into the weekend and your belief in the American economy. Somebody mentioned, I think it was Atlanta GDP is still 2.X%. I mean, it's nowhere near a recession number. Can we do some optimism right now?
I don't know.
Apple, few people are aware of the company, back up to 170X or whatever. How much is a $3 trillion Apple? $191 per share, give or take a little bit. I took that off the Bloomberg terminal. But, you know, these 20 stocks, maybe they're 40 stocks, they keep performing. And up you go from a 173. You go up $20, that's 11%, I'm going to call that.
One of the most interesting aspects of this year.
trillion.
This year actually has been interesting. I want to give a break because I've been saying about how difficult it's been, and it has been. But at the same time, the gains of certain stocks really masks some of the turmoil under the hood. And I think that's what's interesting is the leadership of these names, whether it's artificial intelligence, whether it's just simply the iPhone and the robust sales there. There is a question around whether that can continue and everything else can depart. Sort of the consolidation around the biggest, the strongest, the most innovative. Well, everything else falls out of bed. How long can that kind of divergence continue before there's larger pain? Or is this just sort of the muddle of 2023?
That's a set of worries that are out there. And this goes back, folks, to early morning. I was barely conscious then. The basic idea, Lisa, is that it's exhausting doing this every week. I think I was exhausted last week, and I can't remember, but I think I was exhausted the week before. This has actually been a little calmer, and all we're doing is looking at the shutdown of the U.S. government.
It's been a lot of potential risks,
Right.
potential catalysts, and actual relative capital markets.
Coming up is a special treat. He is private. He is with the Hong Kong Shanghai Banking Corporation. If you care about gold, this is the world's authority. James Steele, next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Aides for President Joe Biden and House Speaker Kevin McCarthy continue to hammer out deals on the debt ceiling after a meeting between the two leaders and other congressional members set for today was rescheduled until next week. Sources tell Bloomberg the postponement is a sign that staff talks are showing progress. Lawmakers are trying to avoid a default on payments. Meanwhile, Treasury Secretary Janet Yellen says the only satisfactory solution is for Congress to raise the debt ceiling. Yellen spoke to Bloomberg in an exclusive interview.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that gets done.
Yellen is in Nagata, Japan for a meeting of G7 finance ministers. Donald Trump is appealing the verdict of a New York jury that found him liable for sexual abuse and defamation. E. Jean Carroll claims the former president raped her and then defamed her by calling her a liar. Trump lawyer Joe Tacopina says that the jury should not have been allowed to hear the so-called Access Hollywood tape. The founder of SoftBank Group, Masayoshi Son, is now personally on the hook for about $5.2 billion on side deals that he set up at the company. That's after the company's Vision Fund venture capital arm ended the fiscal year with a record $32 billion loss. The world's largest technology investor was battered by losses on unlisted startups in its portfolio. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think if gold can establish itself above 2,000, really for the first time in its history, that'll be the first victory for commodity bulls, since that sort of post-COVID run up 2-3 years ago. If you look at gold versus pretty much all fixed income, whether it's long duration, short duration, high yield credit, high quality credit, gold has actually outperformed over the last 5 years. So I think gold has been in a stealthy bull market.
Michael Scholl, Market Field Asset Management, and Christopher Verone at Strategas as well, really underscoring their focus on gold right now. We've underplayed it here, but it's easy to miss with a triple top near 2,000. But the fact is, we need to start focusing on the lift in gold. Lisa, it's been under-talked about on the show. Completely my fault. We're going to have to start focusing on it through the rest of the year.
And the interesting thing is, even though we don't bring it up anymore, a lot of guests are increasingly saying, well, we're putting a little bit more into gold. And that seems to be increasing, especially with some of the uncertainties out there. Even the debt ceiling, right? potentially a catalyst. This is what James Steele of HSBC was seeing with respect to potential upside in gold. He wrote, gold is holding well above $2,000 and gives the impression of being likely to press higher and challenge the record highs at $2,075. The debt ceiling issue and the possibility of a standoff in Washington continuing to the point of a U.S. default may be winning focus from the frailties of the U.S. regional banking sector in the eyes of gold investors. So I guess a shift in potential crises from banks to debt crisis.
That may be the short-term crises, but then there's the underlying on gold. James Steele is authoritative on this with his work at The Economist way back, and then owning the high ground in research at Refco before a long tenure at HSBC. He is their chief precious metal analyst. He publishes The World Stops in Gold. I want to go to the big picture right now, the demand of gold. You're expert on this. Who's moving it up? Is it central bank buying? Is it a secret cabal in Asia that's buying? Why is gold going up? Who's at the margin, the demand?
No, there's no secret, Tom, although the gold market can be opaque. And I think sometimes it's not as visible as other markets.
Lisa, he knows every gnome of Zurich. I know he knows. He's got a little HSBC book with their names all written down. Continue.
In pencil.
And but we have had absolutely standout central bank demand all of last year. Phenomenal, well above, almost double the previous record. And that's continued through to the first quarter of this year. And we've also had very, very strong retail bar and coin demand, which has lasted up until early this year. Now, that's beginning to tail off a little, but I would describe the 15-month rally that we've seen as a combination of a physical demand from the retail and bar coin sector and standout central bank. What's been interesting about it is that this market has rallied in the last 15 months in the face of liquidation from the exchange-traded funds up until recently. We went down several million ounces last year. And that's unusual because it does tend to show that the institutional sector didn't trust the gold rally. And I suspect that's because they looked beyond rising inflation to the anticipated response from central banks and thought that rates are going up, gold will go down. But the retail market did not make that connection, and they simply
this is your charm in that you're not looking at the Fed parlor game. You're looking at the actual fundamentals, almost the Marshallian microeconomics of gold. If we get through the triple top, if Gartman sees 2,400, 2,500, what is the James Steele scope and scale of where demand will take gold? Are you looking out going, 2,600? Or are you looking for an early 80s regime shift of gold on a hyperbolic basis moving higher through 3,000?
Well, that's where, and you really touched it as far as our analysis on where gold can go. Near term, the situation looks quite bullish between a combination of geopolitical stress, the regional bank issue, which goes away and then comes back again and gives gold another boost, and then we drop back, and the debt ceiling impasse. And all of that can take us up in the near term, no doubt, possibly to the point and beyond the record high earlier this year of 2,075. But then as you go on, and if you look at it over many months, you have to take into perspective what the physical market is going to do, which is somewhat 50% of all the physical demand in the world is located in India and China. And a 10-gram bar, which is the favored bar in India, is over 60,000 rupees. That's very, very high. And that's very expensive. And gold is purchased by not necessarily wealthy individuals in India, quite the opposite. And we've already seen imports into India for the available data for the first 2 months of this year contract. I suspect it will also contract in China, although we had a COVID lockdown, post-COVID lockdown spree. Now, that means if that physical gold, which normally it would have gone to India and China, it has to have a home. So the investment side has to keep buying.
That's the Abramowicz household. She's got Krugerrands piled up in the furniture.
They come in handy.
I think that it's more like, gold-plated tin. I think there is a question, though, as we talk about the supply-demand dynamic, what the market is going to do, how much of the demand on the market side, removed from the physical side, is sort of people fleeing crypto assets that were once sort of the replacement for commodities that no longer are.
Well, gold, I think, in a general sense, and it was touched on by the speaker before me, the tape, that the gold has had a resurgence in popularity, in part because it consistently shows itself to be a good safe haven. And it consistently shows itself to be a portfolio diversifier. And other things come up, and crypto may be a very good thing to buy, and I wouldn't say a positive or a negative about it, but it's not a portfolio diversifier, and it's not a safe haven. It's shown by its volatility that it's not. And so therefore, we never really saw much a movement in market share towards crypto. It seemed to be treated separately and not impinge too much on gold.
You were talking about China and India being huge drivers of a lot of the demand. Is there any discussion about pricing the commodity not in dollars?
Well, in general, for many commodities or for transactions, there's been discussions here and there. And that may touch on the de-dollarization argument in general, which may be an element in central bank buying. We're not in the camp of de-dollarization at all. U.S. dollar, in our view, will remain the reserve currency for the foreseeable future. But that's not to say that every single central bank in the world wants to keep the same percentage of dollars that they have now.
Right,
they had
right.
And a very good way, if you don't want to commit to another currency, a very good way for a central bank to get a little bit out of the dollar, but not commit, say, to euro or yen, is to buy bullion.
See, that's again, it's like Goldfinger in Fort Knox. I mean, he advised on that movie a few years ago. I got to ask you, I'm getting a huge response, James Steele, to you being with us. Give me the gold-silver linkage right now. You're right about this. Does silver have any value here relative to gold?
Yes, it does. Actually, we're quite positive on the silver market up to a point. You approach $29 or $30, and you
place setting.
You suddenly get a lot of recycling. There's a great deal that can go back into the furnaces and come out as a bar in a 30 to 60 day period. But the difference, the beauty of silver is that half of it is for industrial demand. And just those areas, now our view on industrial demand for this year is reasonably sluggish. But we do think that silver demand industrially will perform at over twice the rate of global industrial production growth. And that's because it's being used in all the new things.
I get 30 seconds. Do you have visibility on what China's doing with gold? You mentioned it's opaque. Do we have a knowledge of what China's doing in the buying and selling of gold?
Well, we do know what the imports are going in. That's quite visible. And the demand there has been quite exceptional. The data there is quite good. They do have a predilection towards buying gold. There's a cultural affinity. And I suspect that the barrier will be price.
Somebody emails in and says, what's the markup when you buy gold at Tiffany's? I mean, should we ask James that question?
I've never done it, so I wouldn't know.
It's very...
I'm sorry.
No, they just opened their new store. They want to know, what's the markup on gold at Tiffany's?
Any jewelry in the West, in the OECD, is a very, very high markup because you're paying for the artistry and the overhead. And this is the difference between jewelry in Asia and the emerging world, where the markup is much lower. That's why it gets translated, gets translated into the shops right away.
It's great. James Steele, it's been way too long. Thank you so much for joining us here on Gold and Zero. He is with HSBC. Did we survive this week?
I don't know. Are we still alive and kicking?
We're going to be here. We'll be here next week. Join us on radio and television as well. This is Bloomberg. Good morning.